trade and tariff cannot be taken lightly.
The administration is moving forward with fairly aggressive tariffs.
We have now the highest effective tariff rate since we've had since the 1940s.
What is the probability that beyond next week we're putting completely to rest the tariff issue? That probability is probably very, very low.
April 2nd is not the beginning of the end. It's the beginning, and there's a long way to go before the end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday with another company ringing the alarm on the consumer. Lulu shares plunging after the company delivered a disappointing outlook for the year, voicing concerns about consumer spending. The CEO flagging, quote, a dynamic macro environment that's contributed to a cautious consumer, leading to a material impact to traffic across the industry. Add that to a growing list of concerns from consumer-facing companies. Concerns captured by weaker consumer confidence in the face of much higher trade tariffs. The White House seemingly aware of those concerns. The Journal reporting this morning, quote, when President Trump convened CEOs of some of the country's top automakers for a call, he issued a warning. They better not raise car prices because of tariffs. And guess what? Raising prices is exactly what people think they will do.
They have no other choice. If they eat it, it's a multi-billion-dollar hit to their bottom line. You could say, well, they should just make less money. But if they want to invest in factories, et cetera, and actually bring production back to the United States, it becomes very difficult to do so. I will just say the corporate speak for tariffs are hurting consumer sentiment is quite amazing. You indicated what it was, and that seems to be what we're going to hear. The macroeconomic environment that is dynamic is what's causing people to maybe pull back just a little bit. You're starting to hear CEOs directly address the elephant in the room.
They're talking about Trump without actually naming Trump, but they're talking about his policies and the impact the policies are going to have. And as we head towards April 2nd, Liberation Day, as the president likes to call it, there are a number of questions that remain to be seen, but already we're seeing play out in corporate America, most notably when it comes to these consumers. And clearly, I think that Wall Street Journal report shows that this administration actually understands that consumers may get that inflation spike, even if it's a one hit, because of the tariffs.
We've seen it several times through the week that this administration is increasingly sensitive to that story. This market is too. At 8:30 Eastern Time, another read on inflation. Then later on this morning, Lisa, another read on consumer sentiment.
Does the University of Michigan sentiment survey matter? At a certain point, you can make that debate into your rallying cry around whatever partisan group that you want. The more important thing to me is if you take a look at inflation expectations in the market, they are creeping higher. For the next 2 years, inflation expectations have risen to the highest level since March of 2023. Over the next 10 years, you're looking at an average market implied inflation rate of 2.4%. Not catastrophic, but it's not exactly the 2% the Fed's looking for. And if you take a look at what people are pricing in and what Fed officials are saying, there is a lot of skepticism, as we were talking yesterday, about just how transitory some of these inflationary headwinds really are going to be.
Gold this morning, all-time highs. Equities this morning, negative by 0.2% on the S&P. Coming up this hour, Victoria Fernandez of Crossmark with stocks on a two-day losing streak. Brian Gardner of Stifel as the Doge team plans $1 trillion in cuts. And Angelo Zino of CFRA as CoreWeave downsizes its IPO. We begin this hour with stocks steady ahead of fresh inflation data at 8:30 Eastern Time. Victoria Fernandez of Crossmark writing, we have witnessed a definite shift from the animal spirits driving markets to a new all-time high just a few weeks ago to now an increased probability of recession becoming the topic of conversation. Victoria joins us now for more. Victoria, welcome back. A week away from Liberation Day, early next week, that's going to be the big focus for this market. It feels like you've changed your view on things. What's changed?
Well, I think it's actually kind of what you guys were talking about. It's that sentiment of the consumer. When we look over the past year, we kept saying there's so many red flags that tell us we should be in a pullback, we should be in a recession, but the consumer was always there. We talk about a Fed put or a Trump put, but really it was the consumer put for the longest period of time. That's what has changed now. We see the consumer, and you guys have already talked about it this morning, all those companies coming out on their earnings, on their conference calls, talking about the concern that they're seeing, Lululemon being the latest example. I mean, I thought my kids alone would help support the numbers at Lululemon with their purchases, but apparently it is not enough. And the consumers are starting to pull back, and you get in that negative feedback loop. As the consumers start to pull back, revenues come down, margins start to get affected. What happens 9 months after margins get affected? Companies start laying off. And we've seen that with the Challenger layoffs in the last month. And so I think it's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
How much is this company's kitchen sinking it, though? You mentioned Lululemon, and your kids would single-handedly cause this share to go up. But a lot of the kids are actually getting baggy stuff right now. And that was something they addressed, that actually the styles are moving past that sort of trademark legging spandex look. I'm just wondering, how do you parse through how significant the hit is and how big of a slowdown you have to price into market expectations?
Yeah, I mean, it's going to be different for every company. And the companies that have been out there talking about the slowdown have been along a wide range. It's not just apparel, right? We saw Best Buy as one of those. Yes, there was Nike and Lululemon, but you see Walmart, which is a different cohort of a consumer. And I think part of the issue, Lisa, is that it's not just the low income and middle income consumer anymore. We've talked for the last year and a half on that high income consumer really supporting that economy and continuing to spend, even if they shifted their spending habits. They went maybe from a higher element kind of store, now shopping at Walmart. We saw Walmart gain a lot of share, but now they're talking about even the high-end income consumer pulling back. So I think you have to take that longer-term approach and say, as we go through this year and consumers start to pull back as they're worried about their jobs, and we see that in the quits rate coming down, we see it with hiring rates slowing. That's the element you have to look at to determine what does growth look like if that consumer engine is not there driving it.
Peter Cheer earlier told Bloomberg TV that the U.S. is trading trade flows for capital flows, and the rest of the world is going to outperform. Do you look to the rest of the world ahead of Liberation Day because you're really unsure about what is going to happen here in the United States?
Yeah, I think the rest of the world, we've heard from plenty of leaders around the globe talking about the concerns and already trying to make steps beforehand. We've seen it come out of India. We see it come out of some of the European countries where what can we do and before the idea of reciprocal tariffs come to lower that rate? What can we do to help our consumers? We saw inflation this morning out of Europe actually come in lower than expected and ECB rate cuts moving higher. So you have to look at it and see what are rates going to do between the two. What does it look like on exchange rates? International has done much better because of the concept of growth continuing, especially in Europe, with the steps that Germany is making in defense. But has some of that already run out? Is that already priced in to the European market? So I might wait for a little bit of a pullback on international before putting my toe in the water if I haven't already, and let that consolidate a little bit before going there.
Victoria, this is not the only headwind for markets. In fact, the dominant headwind has been the pain trade, and the pain trade's been tech so far in 2025, stateside. Let's think about the shots that's been fired at tech over the last week or so. Reports that Microsoft is pulling back on data center spending. Alibaba firing shots about overcapacity and bubbles, and then overnight, a heavily downsized IPO from CoreWeave. How constrained is the AI trade at the moment?
Yeah, I mean, no one likes that word bubble, but there is a lot of questions now going into hearing all of the money, the CapEx spends that companies were going to do in regards to AI, seeing some of that pull back. You mentioned Microsoft as a perfect example of it. And what does that mean going forward? I think, look, tech, as we went into this correction, tech had already pulled back. They haven't become leadership during this correction period that we're in. So I don't think we should look to tech to be the leaders coming out of this correction. I think they're going to continue to struggle because of some of the headlines that you've mentioned. Maybe you start to look at some of the secondary companies that will benefit from productivity enhancements from AI, and not necessarily the tech names, the data warehouse components of it that people were really looking at. We've seen utility sector pull back a little bit as well because of the headlines that you're mentioning. So I think we continue to see some struggles in tech, and you're probably going to have to look at places like healthcare, maybe certain types of materials, financials. These are the sectors I think that will lead us coming out of the correction that we're in. That's where you should probably focus.
Can you walk us through how all of these prongs of sentiment hits have translated into your view shift over how you should allocate your assets? And I ask this at a time when gold is at record highs and people aren't sure whether to go into bonds or whether to go into healthcare.
Yeah, well, I mean, look, you know, you're talking to the bond girl here, so I would always recommend having some bonds in your portfolio. But people want to hedge what they're seeing. And when there's concerns around growth, gold is the hedge that people go into. When that's not the concern, when growth is actually looking like it might pick up, then you see people go more into industrial metals or things like copper. Copper's actually down this morning after having a pretty good run. Gold continues to move higher. So you see there's that concern around growth. We look at sentiment, and it's always important to break sentiment down and say what's driving that number. Is it the more volatile component of sentiment that's the expectations part, or is it the present situation that's driving it that's usually more focused on jobs and fundamentals? We saw both elements come down in the last sentiment number. So there is maybe a little bit of support to that stagflation argument that people are talking about as we have concerns around the growth component, which supports gold, and still have concerns around inflation and how sticky that's going to be. Obviously, we have PCE later today, but I think you have to look at sentiment and say this feeds into the story of a pullback, of the consumer pulling back, of growth concerns, of GDP concerns, at least in the first half of this year.
Since you're a bond girl, can you really say that bonds are going to have the same kind of buffering effect that they have traditionally at a time where inflation expectations are actually rising?
Yeah, I don't think you're going to go into fixed income right now and say, oh, wow, spreads are going to tighten. I'm going to get, you know, a lot of a price return coming out of that part of the market. I don't think that's what you're going into fixed income for right now. I think you're going into fixed income to lock in some steady cash flow components in your portfolio. Some people may like to do that with dividend payers in the equity market, but that's a little more volatile. If you can lock in some steady cash flow on the short end and the long end of the Treasury curve, it gives you a little bit more buffer in your portfolio as we think we're going to continue to see volatility at least for the next 6 months in the equity side of the market.
Hey, Victoria, appreciate your take on things going into the weekend. Victoria Fernandez of Crossmark, going into a big weekend next week, April 2nd, just around the corner. Lisa mentioned the bond market yield to lower this morning by just 2 basis points, still north of 430. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Canadian Prime Minister Mark Carney says his country will fight back against President Trump's trade war. He declined to outline specifics, but did say his government will respond based on what the U.S. does on Wednesday when Trump plans to announce his so-called reciprocal tariffs. Carney said he expects to speak with Trump in the next day or two. Meanwhile, Bloomberg has learned that the U.S. is pushing to control all major future infrastructure and mineral investments in Ukraine. A draft document grants the U.S. first claim on profits transferred into a special reconstruction investment fund. It also requires Kyiv to pay for all U.S. military and economic support since the start of the war. And Elon Musk says he plans to slash $1 trillion in government spending by the end of May. Musk told Fox News he doesn't think the savings will affect critical government services. The Doge website so far lists about $22 billion in contract savings, while claiming $130 billion in unspecified cost reductions. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later on this hour. Up next on the program, the Doge agenda.
Our goal is to reduce the waste and fraud by $4 billion a day, every day, 7 days a week. And so far, we are succeeding. America will be solvent. The critical programs that people depend upon will work. And it's going to be a fantastic future.
We'll talk about that fantastic future in just a moment. We'll catch up with Gardner of Stifel on the other side. From New York City this morning, good morning. Two-day losing streak coming into Friday. Equity futures at the moment just a little bit softer, but off session lows. We're down by 0.1% on the S&P. On the Nasdaq 100, softer, negative, down by 0.2%. Under surveillance this morning, the Doge agenda.
Our goal is to reduce the deficit by $1 trillion. So every day that passes, our goal is to reduce the waste and fraud by $4 billion a day, every day, 7 days a week. And so far, we are succeeding. When we do make mistakes, we correct them quickly. and we move on. America is going to be in much better shape. America will be solvent. The critical programs that people depend upon will work, and it's going to be a fantastic future.
So here's the latest this morning. Elon Musk aiming to cut 15% of government spending by the end of May, amounting to $1 trillion. Musk's Doge team claiming about $130 billion in savings so far, downplaying government layoffs and saying no critical programs will be affected by cuts. Bloomberg's Tyler Kendall joins us now for more from the White House. Now, Tyler, critical programs in the eye of the beholder, I guess, and that's important. What are the views on what's happening with Doge and whether we can, quote, get those critical programs to be dependable for the people of America?
Yeah, good morning, John. Well, it's a pretty ambitious timeline, as well as those top line figures that you're talking about. The bulk of government spending is really focused on those mandatory programs such as Medicare and Social Security. Elon Musk trying to reassure the American public that the money that they get in their pockets isn't going to change, but it's hard to see how the figures he is talking about he's going to reach those by just focusing on alleged waste, fraud and abuse. So big questions there about the actual implementation of what he is going after here. We have to think about the broader government spending conversation, particularly as Congress looks at some of these programs to try to get through their fiscal agenda and that reconciliation package through both chambers. Now, we mentioned the figures, the timeline here, also considered to be pretty ambitious. The end of May, Elon Musk is a special government employee. That means he's only supposed to be on the job for 130 days out of the year. 130 days from the inauguration would bring us to May 30th. That's not to say, though, that he's not going to still be involved or the effort's not going to continue, although Doge is supposed to sunset by July, so another date for your radar. But this really has been billed to us as a whole of government approach. We see Elon Musk, for example, sitting in on those cabinet meetings to get updates from department heads. Of course, John, this all goes into the heightened concerns, too, among federal workers. So spending on one end, but also job cuts on the other. Elon Musk saying that up to this point, quote, almost no one has been fired. We should point out that just yesterday, HHS announced that it was cutting 10,000 jobs. And it's important context to keep in mind, only about 20% of federal workers are here in the nation's capital. This is going to have some broad-ranging impacts across the country.
Tyler, you mentioned reconciliation. How do the Doge efforts square what they're trying to get done in Congress?
Right. Well, Annmarie, it's pretty interesting to see how they're both kind of working in tandem here, perhaps, but Congress wants a bigger role. There is reporting that just yesterday, key Senate Republicans met with some top White House officials, including NEC Director Kevin Hassett and the OMB Chair Russ Vogt about what's known as a rescission package. This would essentially let Congress codify some of these spending cuts by allowing them to vote to pull back some money that might have been allocated but not appropriated yet. So that's one line that's going here. It remains to be seen if the White House is willing to give Congress that part of this discussion. And then the other end, of course, are the spending cuts. We know yesterday our Bloomberg News reporting that the Senate package is looking at lower minimum spending cuts in order to kind of quell some of the concerns among Republicans about what it could mean for the future of Medicaid. But again, Annmarie, bringing up big questions. If there are less spending cuts perhaps on that program, what does that mean for those fiscal hawks that need to see larger spending cuts to make up for some potential impacts to the deficit and raising the debt ceiling?
Hey, Tyler, thank you. More from Tyler later on the programme in the next hour. To extend the conversation, Brian Gardner of Stifel. Brian, just to pick up on some of this, can Washington agree on which programmes are critical?
No. I mean, the short answer is no. I mean, the critical is in the eye of the beholder. There are definitely members up on Capitol Hill that are going to see most programs as absolutely critical. That it's a jurisdictional turf fight battle. So it gets into the question that you had earlier on the savings of Doge. How big is it? How transparent is it? And how much waste, fraud, and abuse is it? Well, waste, fraud, and abuse is in the eye of the beholder. So critical programs, the same thing, kind of in the eye of the beholder.
When it comes to critical programs, could Republicans meet their goal of cutting $880 billion under the committee of the Commerce Committee in the House without touching Medicare?
The math doesn't work. I mean, if you go through a list of options that various groups can put out, the House Budget Committee had a document out. The Congressional Budget Office has given options over the years. And you look at the jurisdiction that Energy and Commerce has, well, it really is Medicaid. There are not enough programs under its jurisdiction to get to 880. The math just doesn't work. So if you give that committee that target, at the end of the day, it gets to Medicaid. And we can debate what the value is of Medicaid. Not so much what the value of Medicaid is. Excuse me, that's a poor way to phrase it. But how to make it more efficient, how to get savings out of the program. But 880 is going beyond just waste, fraud, and abuse. That's getting more towards the bone of the actual program, not just the fat around it.
So where do you see Senate Republicans coming up on this issue, given the fact that they're in the midst of writing their bill right now for the budget, and potentially we could see a vote next week?
Yeah, I think they're trying to have it both ways. We're kind of signaling that there may be some flexibility on one side of Capitol Hill, less flexibility on the other side of Capitol Hill. Create a budget resolution that it's somewhat illusory and kicking the major questions down the road to the actual reconciliation bill, at which point members will be jammed to vote for or against the bill that you're going to claim, the leadership is going to claim if you block it, you're blocking the Trump agenda. So I think they're trying to come up with an artful way of splitting the baby in half to give some deference to the House, to recognize that the big issues in the Senate need a different approach. But there are two camps, right? You have the budget hawks who want much deeper cuts, Mike Lee, Ted Cruz, and a few others, Rick Scott of Florida. And then Josh Hawley, who, I think most people would view as a conservative, but is, in the populist conservative camp and is expressing a lot of concern over the level of cuts in Medicaid. And so there's going to be an interesting debate next week on the Senate floor. And we'll see if the vote actually happens. I think John Thune is at a point where he's just trying to force senators to decide in order to get to an actual vote. It would not surprise me to see that vote punted.
Brian, how much are Republican Congress members counting on revenues from tariffs and really helping give them an easier time in getting something passed?
I think there's such a lack of transparency and specificity of what those numbers look like. So I think conceptually, Lisa, they're saying, yeah, we're going to have revenue coming in from tariffs. No one can really give a solid number of what those numbers look like. And within the reconciliation package, you're going to have some level of specificity in order to score it. Maybe there's some way to codify these numbers, and so they actually do get some budget savings, and then it's the art of actually writing legislation. But it's such a gray area, and there's so many claims being put out there, on the tens and hundreds of billions of dollars of revenue that are going to be brought in by tariffs. But, we also don't know what the timing of those revenues are. I think part of the revenue discussion is that the Trump administration is looking to really restructure the American economy. And they believe that there's going to be a massive inflow of capital into the United States and an economic boom that's going to result. Well, those revenues are going to be in the out years, and how that gets scored into a budget reconciliation bill is anybody's guess.
Hey, Brian, good luck to them. As you said, art, not science. Brian Gardner there of Stifel. I don't see how you come up with a number, especially the president said earlier this week that he's willing to negotiate with China, drop the tariffs to grease the wheels for a TikTok acquisition. So how do you come up with a number?
Taking it a step further, how do you come up with a number when the whole goal is to bring production back to the United States, which ostensibly
you don't want them paying the tariffs.
Remove the revenues that would come from some of the tariffs. So this is a very tricky thing, and it raises a question of how much of an offset it is to what the Republicans in the House are trying to do.
Got a lot to get through this morning, that's for sure. Equities right now just about unchanged. Lulu's down by 13% in the pre-market. We'll pick up on those consumer concerns a little bit later. In the next 30 minutes, we'll also be talking about a big downsizing of a big IPO. We'll talk about that in about 20 minutes' time. Up next on the program, Winthin of Brown Brothers Harriman on his outlook for the dollar as tariffs drive huge uncertainty. From New York, this is Bloomberg. Equity futures here slightly softer. We're down by 0.1%, going into the weekend on a 2-day losing streak, but poised for a second week of gains. We'll see if that holds. On the Nasdaq, we're down by 0.2% also. Let's get some morning movers for you. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. A really painful pre-market move when it comes to Lululemon. Down nearly 13%. If this holds, it would be its worst day in about a year. It is about their earnings, a downgraded outlook to come forward, warning on the consumer, saying that the macro uncertainties means that they are tightening their wallets and they are pulling back. Is it about that or is it about strategy? Lululemon has been falling behind as we change to looser fitting type clothes. They also noted that tariffs, it will slightly impact their margins. Now, speaking of tariffs, we're still looking at the automakers. Ferrari up 1.5%, getting an upgrade from both Kepler and Barclays, saying that they are in a unique position to do okay. And that is basically that they have a luxury customer, that if they do indeed need to raise prices, that they have customers who are being willing to pay up. Now, speaking of that, a really interesting Wall Street Journal story out this morning reporting that earlier in the month, Trump had held a phone call with the U.S. car makers saying, do not raise your prices as a consequence of tariffs or else you will be punished. Now, is that moving GM or is it just continued dourness over the tariff story? Either way, those shares, John, down again in the pre-market after falling 7% yesterday, down nearly 0.6%.
Hey, Danny, thank you. We'll get to the pricing story a little bit later. My favorite story in the market yesterday, Hertz. Did you see that?
I did. Shares
Stock
surging.
Rocketed on this assumption that this is going to make used cars more expensive, which makes their fleet more valuable.
It wasn't just Hertz. It was all the auto rental cars, because remember, their shares absolutely plummeted when the price of cars was going down and the used car sales market was slowing down. This is just gives you a sense of the market response, regardless of what President Trump is telling car manufacturers to do or not do with their prices.
You know, at the surface, things are calm, stable, almost over the past few days. Beneath the surface, we've seen some big moves. On our radar this morning, setting the tone for this market, CoreWeave raising just $1.5 billion in its IPO. The cloud computing provider cutting back its plan to raise as much as $2.7 billion. The downsized deal reflecting how stock market volatility is hurting demand for IPOs also speaks to the jitters we've seen in this theme so far this year.
Yeah, just to make sure that we understand the context here, more than 3/4 of its revenue last year came from 2 customers, including Microsoft, major hyperscalers. This is a company that is highly leveraged to this trend of building out massive data centers for artificial intelligence training, and it is going to be the ultimate litmus test of how much people maybe are getting ahead of their skis in terms of what the pricing is for this. It came in at the very low end. It's being anchored by NVIDIA, and it raises questions about the tenor for other IPOs that could come to the market later this year.
CoreWeave, a customer of NVIDIA.
Exactly.
NVIDIA, an investor in CoreWeave.
Basically, this is just a leveraged aspect of both NVIDIA and the hyperscalers of trying to allow them to have extra capacity without committing to it. So this is what's going on, and right now we're seeing a lack of demand for that.
It's been quite a week and quite a year for this part of the market, hasn't it? Started with the DeepSeek revelations, really upended the equity market. This week alone, Alibaba coming out and warning of overcapacity in a bubble. We saw from TD Cowen, I believe, they warned about Microsoft pulling back from projects in both the United States and in Europe too. This whole sector has been really challenged for the last several months.
And China has piled on, and it's unclear how much is truth and how much is actual innovation that's going to transform the need for a certain level of capacity, and how much is them saying to the U.S., all right, we'll see your tech sector excellence and we'll raise you innovation that's going to eliminate the need for some of that. Look, there is some kind of truth in between here, and people are trying to find that right price.
Angelo, Zino of CFRA joining us in just a moment to talk about that right price. I want to turn to this story. Danny mentioned it, Lulu delivering a disappointing outlook for the year ahead. The CEO pointing to a, quote, cautious consumer. Due to geopolitical uncertainty and high inflation, the company's first quarter revenue outlook also falling short of expectations.
This is just another pile-on of companies that have come out and said the uncertainty among consumers is causing a retrenchment from some of their spending concerns. I love the way that they say it. I mean, the corporate speak, the macroeconomic uncertainties out there are causing a retracement. I mean, look, they're concerned about this. The question I have here is their biggest growth area, China. How do they deal with the fact that China and the U.S. are embroiled in this battle at the same time that's the one pillar of hope right now for this brand?
And when it comes to China and the United States, that trade war can only deepen. it might get worse, the tit for tat. What I thought was so interesting also about Lululemon, they're already seeing the traffic starting in February when really you saw tariff rhetoric start to heat up in Washington. They're seeing the traffic decrease in the United States. That's going to be very challenging as we head towards Liberation Day.
Let's get to Liberation Day and the tariff reaction. They will because they can. Ferrari planning to raise prices for some of its cars in the United States by as much as 10%. It's the first European automaker to update investors in response to President Trump's new auto tariffs. The stock is up this morning by 1.5%, truly priced inelastic. In economics, if you ever get to study it, it's called a Veblen good. Basically, the value of that good goes up as you raise prices. People want more of it. And that's what's going to happen with Ferrari too, you'd imagine.
And here's my violin, and here I'm playing it. And all those people who are paying, $500,000 to buy their Ferraris, at the very least, they're going to have to pay an extra $10K. My question isn't really for the Ferrari owners. It's for the rest of us mortals. And this question of what the average price of cars is, yes, the price and elasticity there is notable. The price elasticity, or the fact that demand will fall off for some of the more sanely priced cars, is going to be a much bigger issue. And that's where the focus really is going to turn.
I like what Bernstein had to say. Actually, if you own a Ferrari, you might welcome these tariffs because it just means the Ferrari you have in your garage is actually going to be worth a lot more now.
It's like Hertz on steroids. Very, very different story. Look, this is a very, very different story. If you think about the environment, I think we have to think about this. How fertile is the environment for runaway inflation? Now, if you talked about that from a labour perspective, people would say the labour market's just not as tight as it was 2 years ago. I think if you think about it from an industry perspective, just consider where this industry has been over the last couple of years. They've had to cut prices. They've had to get people to buy these cars because people aren't willing to come to the lots anymore and pick up an electric F-150 or whatever it might be, the Lightning truck from Ford. That's the issue they've faced at the moment. So if they put prices up, demand's going to drop. And that's the problem for them at the moment. That's the stagflationary theme we've been discussing.
Here's some numbers on that. Right now, the average price of a new car in the United States is $50,000. That's not including interest rates that you would pay if you would take out a loan. There are only 20 models right now that are selling for $30,000 or less. And right now, at least half of them will experience a price increase of about $5,000 a piece if those tariff prices are passed along. You start to talk about a lack of ability to buy a new car, which is the reason why those car fleets are going up in terms of valuations for some of those rental cars, and the reason why Donald Trump is telling car manufacturers, don't do it. Question is, who's going to bear the hit, and how is that going to be felt in the economy?
With sticky high inflation, softer growth, it's the stagflationary fears that I know a lot of people have got right now. Equity futures on the S&P just a little bit softer, down by not even 0.1%. The FX market in focus with the dollar at risk as Trump tariffs play out. Win thin of Brown Brothers Harriman saying next week will be key in confirming or denying the end of US exceptionalism and dollar dominance. Win joins us now for more. Win, welcome to the programme. What's special about next week and what are you expected on April 2nd?
Hey, first of all, thanks for having me. I miss chatting with you guys, and it's always a pleasure to come on this show. Well, it's a big week in many ways. We've talked about so-called Liberation Day with tariffs next Wednesday, but we're also getting a lot of key data for the U.S., ISM, and other jolts, but culminating in the jobs data Friday. And I think it's key because as you noted before, the tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect. And the market's attention goes back and forth. First, we focused on the inflationary part. Now we're focusing on the stag part as we see business confidence, consumer confidence fall. So it's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. Everyone bullish on U.S. equities, the U.S. dollar. And really, we kind of hit a wall. And it's really just due to this policy uncertainty. I'm hoping that perhaps next Wednesday will be the beginning of the end of some uncertainty, but I'm not going to bet the house on it.
Meanwhile, we've seen dollar destruction or value destruction over the past year until recently, when you've seen the dollar strengthen just a bit versus some of its competitors, some of the other G10 currencies. I just wonder, at what point do you see this as a pivot where suddenly people start to think, OK, maybe the U.S. isn't going to be the epicenter of pain for some of these tariffs, but the rest of the world is going to get hit just as hard, and that's going to lead to further dollar strengthening.
Yeah, absolutely. So look, if the U.S. goes into recession, the global economy is in trouble. We've been the global driver of growth for the last several years. Yes, the Eurozone is kind of picking up a little bit. Maybe China has some stimulus up its sleeve, but really the U.S. has been the only game in town. So if you're in emerging markets, the last thing you want to see is the U.S. go into some sort of downturn. So that's the problem with tariffs. A lot of the policymakers, I believe, in the U.S. are looking at it in a very partial equilibrium kind of view, like well, we're going to do these tariffs and everything will be hunky-dory. But there's retaliation, there's second-round effects, there's all sorts of distortions and uncertainty being introduced that I think once you let the genie out of the bottle, it's very hard to get back in. So I think that's why markets are so nervous right now across all markets, fixed income, equities, FX. Markets hate uncertainty, and yet we are right deep in it. As Fed President Barkin said yesterday, we're in this deep fog, pull over to the side of the road and put your blinkers on kind of uncertainty. And I totally agree with that.
I love it. It's a deep fog, put the blinkers on, pull over, and people come to you and say, what do I do? What do you tell them?
Well, look, here's interesting. The Fed is sort of in that same fog as we are. I'm trying to look through the noise. The tariffs are certainly a big spanner in the works. I think a long-term view, which is for FX markets, maybe a couple of months, longer-term view in a couple of years, I would say. I think the U.S. dominance is still there in the sense that the innovation is here, the AI, all the sort of things that you want are still here. So looking through the noise, I still remain positive on the U.S. economy. But I have to be honest, this is probably the most nervous I've been about the U.S. outlook in a good year plus. And again, it's all policy related. It's just this uncertainty. No one likes this.
Even more nervous about the outlook than we saw during COVID?
Well, okay. Well, that's COVID is obviously
well, a lot of surveys, people are saying that. That's why I'm keen to get your view.
Yeah, I know you're right. Some of the confidence surveys are back to the COVID lows. Look, right now we've been fortunate that the hard data has not quite reflected this huge drop off in sentiment, and that's always the question: are people really going to pull back all their spending? Are they going to delay it or eliminate it altogether? That's the big question. And the retail sales in January and February were a little bit softer than expected. Part of it could be weather related. Again, this goes back to that fog. We had the cold weather, we had the wildfires, all that. So again, I'm going to go back to Mr. Bostic of Atlanta Fed. He said, look, this uncertainty, I may not know until late spring, early summer. And again, that's for the market, that's an eternity. So a lot can happen in weeks, but in the next couple of months, I think we'll have a better idea of really how the U.S. economy is faring with this. The only good news I have is that we went into this, with a lot of momentum. We're at full employment. Inflation is elevated but coming down. So, we're in a strong position, but it's really a tricky time right now for investors and households and firms.
Each week feels like an eternity, Win. You know that. It's good to catch up with you. Good to see you. Win Thin there of Brown Brothers Harriman. The summer feels like an eternity away. We've got to get to April 2nd first. We've been building up to April 2nd now for what feels like months.
And we can keep building up, and we'll build up afterwards to May 15th or whatever the end date's going to be, because we're not going to get much clarity. Tom Barkin yesterday of Richmond Fed coming out, and we were talking about that with Win, saying the policy changes have created, a quote, a sense of instability in the business community. This has something that a lot of people have gained attention from. It is the uncertainty alone that is starting to cause some, maybe not permanent damage, but real question marks around how long this can go on.
Consumer-facing companies are telling you it's not great. Several of them, and we heard from another one, Lululemon, in the last 24 hours. The sentiment survey data is telling you things are terrible at the moment, but the hard data, payrolls next week. I don't think you can overstate the importance of the hard data from the labour market through next week. It's not just about April 2nd.
The hard data lags behind the soft data for about 3 to 6 months. So people can keep pointing to that as, look, everything is just fine. And people who track the data will say, really, we have no way of knowing that. So that's kind of where we are.
That's what the Fed chair's doing, isn't it?
Pretty much.
Everything's all right.
Everything's
still
all
look
right.
healthy. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hekes. Hey, Yahara.
Hi, John. U.S. Attorney General Pam Bondi is suggesting she won't seek an investigation into the Signal group chat that saw Trump administration officials reveal sensitive military plans to a journalist. Bondi says the episode was a mistake, but no classified information was discussed. She added the mission was successful, making the world safer. Meanwhile, the Wall Street Journal reporting President Trump in a call this month warned auto executives against passing on costs to consumers. That was ahead of his announcement. A 25% tariff will be placed on all imported vehicles and parts starting April 2nd. Trump reportedly told them they should be grateful for his elimination of President Biden's EV mandate. And President Trump is withdrawing Representative Elise Stefanik's nomination to serve as the U.S. ambassador to the United Nations. In a Truth Social post, Trump said, with a very tight majority, I don't want to take a chance on anyone else running for Elise's seat, adding there are others that can do a good job at the UN. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later. Maybe it was hubris, overexcitement in the immediate aftermath of the election, but I think we're all surprised of that pick, about that pick to begin with?
I think a lot of people are surprised it took them this long to realize there's another Republican in the House. They cannot lose if they want to get their agenda across the finish line.
We'll catch up with Congressman French Hill about that agenda in the next hour. Up next on the program, big tech under pressure.
Markets are down. It's not just a rotation underneath the surface. If you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got, kind of a perfect storm or an imperfect storm.
We'll catch up with Angelo Zino about that imperfect storm. He joins us from CFRA in just a moment. From New York, this is Bloomberg. Going into the weekend with equities just about unchanged on the S&P 500, the Nasdaq down by 0.1%. The Nasdaq 100 still off the highs, down by more than 11%, or around 11% from the highs of the year. On the Nasdaq 100, haven't recovered at all really for that index. Under surveillance this morning, big tech under pressure.
Markets are down. It's not just a rotation underneath the surface. If you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got, kind of a perfect storm or an imperfect storm. What equities want is certainty, even if it's bad certainty.
So here's the latest this morning. Concerns over AI demand and valuations for big tech weighing on the most anticipated IPO so far this year. Nvidia-backed CoreWeave raising $1.5 billion with a starting share price of $40. The firm initially seeking to raise as much as $2.7 billion ahead of its first day of trading later on today. Angelo Zino of CFRA joins us now for more. Angelo, welcome to the program. What kind of signal do you take from this heavily discounted IPO?
Well, first off, thanks for having me. But when we kind of look at this, I mean, we're not necessarily surprised by the discount here. And I don't think most in the market are necessarily surprised kind of in light of recent events and what we've seen over the last couple of weeks from just overall sentiment on the tech side of things, just, really kind of going sour. Overall, you've got these tariff macro issues out there and the implications that they're having on, tech. You've got these, obviously the DeepSeek concerns out there and the implications on the tech side of things there. I think also as far as CoreWeave is concerned specifically, when you kind of look at that business model and kind of, how they handle the financing side of things, kind of being more of this kind of GPU infrastructure-backed lending type of company. I think that's a business model that really doesn't kind of, bode well with a lot of investors out there, especially amidst a period where kind of we've got a risk-off trade for AI right now.
It's a huge risk-off trade and has been ever since the DeepSeek revelations, Angelo. So let's build on that. It's not just that. Alibaba out this week. The chairman came out and said maybe there's some overcapacity, perhaps even a bubble. Then we had a report from TD Cowen that suggested Microsoft was pulling back from projects in both the United States and in Europe too. It's a question we asked earlier this hour, Angelo. Just how constrained is this trade at the moment?
Listen, I think when you kind of look at the sentiment out there, I mean, it's pretty negative. I mean, we kind of look at the hyperscalers out there from the likes of Microsoft, Oracle, Meta's out there declining anywhere from 15 to 25%. When you kind of look at the AI semi names out there, they've kind of declined more notably, kind of in the 25 to 50% range out there. So a lot of kind of the uncertainty out there, whether it's kind of what you alluded to as far as the Microsoft situation is concerned. And I think that'll be the most important event this earnings season is that earnings call from Microsoft. We really need to hear from them, find out exactly what their intent out there is. I mean, our view is it partly has to do with that OpenAI relationship, as well as the fact that, hey, listen, maybe and they clearly articulated the fact that they are going to shift more towards their server side of things and less towards the infrastructure side of things, which we think makes a lot of sense. We do like the Microsoft trade at this point in time, given the pullback. But there's a lot of uncertainty as far as all that is concerned out there. We think a little bit kind of to an extreme, and we do think a lot of those valuations are kind of baking some of that stuff into it.
To build on that, I'm kind of whipsawed here because it was just a couple months ago that we had people on here who are saying that truly these hyperscalers can't invest enough in infrastructure, and that frankly the energy system and the infrastructure currently out there is nowhere near what's necessary for the AI build out as people imagine it. So which is it? How do you understand how much what we're hearing from China is fact versus fiction in terms of just how much technological advances transforms that story?
Yeah, no, I think that's a great question. And I don't know if there's an actual way to answer that, to be honest with you. But when we kind of look at it, right, I think DeepSeek did change things more than people kind of want to acknowledge out there. I think you kind of take a look at China, look at the efficiencies that they've kind of accomplished on their end of things. And then you kind of look at what's happening in the U.S. And I think kind of that's the bigger issue out there, because if you kind of look at the pace that these kind of hyperscalers are investing at, and now at a point in time, right, where we do have these tariff concerns out there, we do have those growth concerns out there, at a point where we could potentially see some pressures on the top line, whether it be, come from some deceleration on the cloud side of things, whether it be, some challenges on the digital ad side of things. That puts pressure kind of on these hyperscalers out there, not to mention these tariffs out there also increase the cost of kind of installing these servers out there. So these hyperscalers are going to have to look to be a little bit more efficient in nature. And in many cases, what we've seen here over the last couple of months is really going to force them to do that.
Is CoreWeave a litmus test for other potential companies that want to IPO this year in the tech space? Or is it idiosyncratic, and I hate to use that word, but special because of its connection, particularly to some of these areas that are part of the peak uncertainty?
Yeah, I mean, we personally wouldn't be using them as a benchmark for other potential tech IPOs and other IPOs in the market out there. Again, this isn't the name that we would potentially or would like to see as kind of that first name being thrown out there in this tech IPO market, kind of since the Trump administration has taken over. But that said, this is what we've got out there. It is going to be somewhat of a test out there. We'll see what the sentiment looks like. But in our view, no, it shouldn't kind of be used as kind of this test longer term or over the next 9 to 12 months in terms of what the sentiment looks like for tech longer term.
So Angelo, for you right now, top pick, what is it?
It's a great question. I mean, we've told investors over the last couple of months to continue to shift towards software over semiconductors. Now, we'd acknowledge that neither side have really kind of worked that well, but we'd say the lesser of both evils right now is still in the software side of things. We remain believers kind of on the side of things where you are going to see more M&A on that side of things. We also believe that kind of the fundamentals are also going to hold up better on the software side of things. And for us, a name like Microsoft at these levels is a name that I feel pretty confident recommending to investors. I think Salesforce is another name which has seen a notable pullback as well, which is a name you can kind of be looking at these levels.
Angelo, appreciate the input. As always, thank you, sir. Have a good weekend. Angelo Zino there of CFRA. Hardware's had a tough run. Let's take the NASDAQ, for instance. I mentioned it was down close to 11% from the highs of the year. We're down more than 25% on NVIDIA still from the highs for 25.
Microsoft down more than 7%, even though its revenues are something of a small country. So at a certain point, you have to wonder, do you just go back to the names that people love and have owned, or do you start to invest in some of these upstarts that have a lot of potential question marks hanging around them?
We'll see how that trades a little bit later. Equity futures right now on the NASDAQ at least down by 0.25%. The S&P 500 just a touch softer. No real drama. In the second hour of Bloomberg Surveillance, your lineup looks like this. Bruce Kasman of JPMorgan, Michael Zezas of Morgan Stanley, Congressman French Hill of Arkansas, and Earl Davis of BMO from New York City. This is Bloomberg.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
What equities want is certainty, even if it's bad certainty.
The difference between uncertainty and volatility is that volatility can be priced while uncertainty can't.
You can plan for risk, but you can't plan for uncertainty.
It doesn't feel like Liberation Day is going to be Clarity Day. And so I think a week from now, we're still going to have a lot of questions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's check out your scores. Equity futures just about unchanged on the S&P 500. On the Nasdaq, softer by 0.2%. We'll talk about a very disappointing CoreWeave IPO later on in the program. Outside of that, we need to talk about a very disappointing outlook from Lulu. That stock is down and down hard in the pre-market. Another consumer-facing company takes a hit from a falling consumer sentiment read in the United States of America. That just continues. We'll get another read on that later on this morning when we get consumer sentiment from the University of Michigan. What are they worried about? Higher prices, core PCE, later this morning.
And let's see how much people start to consider the University of Michigan some sort of leading indicator once again after Fed Chair Jay Powell dismissed it. Look, what we're hearing from companies, and you mentioned Lulu, and arguably earnings season this time around will be more important than the soft data and the hard data, because what we hear from corporate executives might be the cleaner read, frankly, on the quickly moving consumer appetite. What we heard were these scathing comments from the CEO. We are operating within a dynamic macro environment that's really contributed to a cautious consumer, where we've seen a material impact of traffic across the industry. Look, they are seeing U.S. consumers pull back. They are seeing consumers elsewhere not have the same kind of trend, and they are concerned.
Are you suggesting they're worried about telling the White House how it is directly?
Well, how else can you interpret that? I mean, these words are not English. They are corporate speak. They are another brand offshoot of English, a way of saying there is a real concern about tariffs and people aren't shopping as a result. But that's the way it comes across.
You know how this works. You put all your complaints into the computer, spits it through one of those McKinsey chatbots, and you end up with what Lisa talked about.
Because you want benign language, maybe some corporate jargon, because you don't want to really go after what's actually going on to not have the ire of the President of the United States, who I think the Wall Street Journal reporting today on the front page shows that this White House is acknowledging that tariffs might mean prices are going to rise, because apparently when this phone call with auto executives, the president said, don't raise your prices when I announce my auto tariffs.
Don't raise prices. They're not in a great position to raise prices, and I think that's the problem at the moment for some of those automakers. If they have to take it on margin, they're not in a position to expand either. They're between a rock and a hard place.
Which is the reason why Dan Ives came out and said this is absolutely catastrophic for the auto industry. A lot of people would agree. Yesterday, it seemed like this market was slow to come around to just potentially how damaging some of these tariffs could be. Initially, the losses weren't that significant. As the day went on, I believe GM was down by more than 7% just on the day alone. People trying to understand how do they get out from around this at a time when the president is saying this is it. These are permanent. 100%. These are not going away.
And people are like, are they? We'll see you April 2nd. We'll see you in a month from now. We'll see how permanent they actually might be.
Dan, I've said the same thing.
Jim Reed of Deutsche Bank had this quote: the more you listen to the current U.S. administration, the more you appreciate that they are prepared to sacrifice near-term market performance and economic growth if it's required to meet their longer-term objectives, which I think says to me, at least at Deutsche Bank, they're taking this for what he's saying. These tariffs are real.
It's the market. More economic data coming up later on this morning. Coming up this hour, Bruce Kasman of JPMorgan as trade concern continues to weigh on markets. Mike Zezas of Morgan Stanley as Canada vows to retaliate against Trump's tariffs. And Congressman French Hill as Republicans work to pass Trump's tax agenda. We begin this hour with stocks steady. Investors counting down to core PCE at 8:30 Eastern. Bruce Kasman and the team at JPMorgan raising their recession forecast to 40%, writing rising concerns about a trade war are combining with elevated U.S. policy uncertainty to weigh on sentiment. Bruce joins us now for more. Bruce, welcome to the programme. It's a change for you and the team. It's not 0, it's now 40. When does it become the base case, Bruce? What do you need to see?
Well, we'll reassess next week. And I think the other thing here is to realize that what we're getting is a drag coming from tariffs, a drag coming from immigration, a drag coming on the fiscal side, which are bigger than we anticipated at the start of the year. But those are not drags which we would think fundamentally threaten a healthy economic expansion, which is the way we would describe the U.S. I think it's these magnifying effects. And I think there are 3 of them that are quite important here. One, and perhaps most importantly, does the market, does the business sector shift its view to this being a business unfriendly administration, at least in terms of near-term growth and performance? That could deliver a very big drop in sentiment. We've seen sentiment start to slide. I don't know how far that's going to go. The second point is the consumer. We know we're going to get hit by higher inflation here. It's going to eat heavily into income gains in the next 3 to 6 months. consumer can cushion it. It may not want to cushion it in the environment of the uncertainties and concern about inflation. And then finally, the way you're implementing policies here are particularly disruptive for North American sectors on the immigration, on the tariff side, and other ways. And I think you have the risk that there's more disruption in the U.S. economy. So we think the risk of a recession is high. It's a fluid situation. We're going to adjust it on policy. And I think it's these soft issues around sentiment, around disruption, around consumers cushioning purchasing power that are probably going to be more important here than the actual size of the tariffs we see and hear next week.
Bruce, coming into 25, you said the big risk was countries retaliating disproportionately. Do you still see that as the big risk?
No, we came into this year, I just want to emphasize, saying the risk was sentiment. The title of our year ahead outlook is in a sentimental mood. But having said that, I do think you're right that there is going to be more retaliation and more targeted retaliation that can both increase the drag on the U.S. and the potential for disruptions. And I don't think we should underestimate what happens next week if we get broad-based tariff increases on the rest of the world.
When do you expect, Bruce, to see this in the data? What data is the most important to watch at a time where ostensibly we're all data dependent and yet pushing off all the data is not yet really tracking the current circumstance?
Well, the data is kind of funky right now because we're tracking a 0 or so on U.S. first quarter GDP. But without going into the details, I think that's a very misleading signal about where underlying growth is. We're also getting a front loading in global industry as producers, particularly coming out of Asia, are sending goods to the U.S. market. U.S. goods are shifting out in anticipation of tariffs. So there's a lot of difficulty in reading the data. I would emphasize the interaction here between what we get in terms of business behavior, household sentiment, and what we see in the labor market. In the end of the day, recessions are about labor market breaks. When you break down and you get private payroll growth sliding well below 100,000 a month, that's a signal we're in trouble. We don't think this is going to happen in the next few months. We don't think it's going to happen in next week's payroll report. But that's the heightened risk around where we might be as we move through the middle part of the year and later on.
Yeah, but Bruce, isn't the employment market a lagging indicator? Doesn't it usually crack well after the seeds of some sort of recession get sown?
No, I think employment is coincident. I think there are indicators of employment that may be lagging, including the job number. I think you pay attention to layoffs, you pay attention to surveys. But I think the labor market moves coincidentally with the economy. When the economy breaks, the labor market is breaking.
Bruce, what would you make if actually all of this uncertainty ended up being better deals for U.S. companies? The UK government right now trying to negotiate exemptions. Maybe they'll get some. India right now is looking at U.S. demands to cut the levies of imports of goods like agricultural products. What if this ends up with better trade deals?
Well, I think that comes back to my basic hypothesis, which is the call here is whether what's being implemented here, what's being discussed going forward, is designed to provide a support for the U.S. business sector, not over a 5 or 10 year horizon, but over a 6 to 18 month horizon. And I think your point is right, and it's one of the reasons we're not over 50% right now. It's still not clear how this is playing out in terms of the way tariffs are going to be applied. I felt coming into the new year that was a reasonable baseline to have. After we put tariffs on Canada and Mexico for one day, even though we took it off, and some of the other things we've been seeing on tariff and other policies, I'm no longer comfortable taking that view. You may be right. We haven't gone all the way to a recession call, but I don't feel confident that that's the way this is going to play out.
Of course, we're also waiting for the other pillars of the Trump agenda, which is more deregulation and the extension of tax cut, the TCJA, and maybe even more tax cuts. By the end of the year, if you have the composition of all these policies, do you think you're going to be over 50% or under 50% when you have recession risks?
Well, we're at 40% right now, which is to say we don't think we're going to get the magnification through sentiment. And part of it is what you're suggesting is that we extend TCJA, that the regulatory arrow is moving to reduce the burden. The question is whether that is going to balance what we see elsewhere here. I would just note that the fiscal debate should be understood right now to be tightening on the spending side. State and local is an important part of that. And TCJA extension, while it's a positive in the sense of not letting the tax cuts expire, doesn't add to demand in the economy. It's just an extension of current policies.
Bruce, what could you hear next week that makes you think that the market is truly shifting its view to look at this administration as business unfriendly, not business friendly?
Well, I think what we would be looking at in a constructive way would be limited retaliated tariffs and a focus on pretty much narrow sectoral tariffs, as we saw with the auto announcement yesterday. So if we see autos, pharmaceuticals, perhaps, as you were pointing out a couple of minutes ago, efforts on the retaliatory side to open up other markets to U.S. goods, I think that would be the comforting message. I think a broad-based tariff increase, a step towards having an outright trade war with the EU, those are the kind of things that would be worrisome. And of course, there's the question of whether or not we're kind of closing the door of this chapter of the tariff story, or whether we're simply kind of moving incrementally down the road towards a broader trade war.
Bruce, just to wrap things up, to finish on inflation, I'd love your view on where the labour market is. Do you believe it's tight enough to worry about second-round effects from the inflationary impact of tariffs?
I don't think the economy is positioned for 2% inflation, independent of what's been happening on policy here. I don't think the labor market is super tight, but I think the combination of the starting point on where labor costs are, where psychology is, and where labor demand is moving, of course, towards a weaker labor supply story as immigration cools. I don't think that, and incorporating what's happening globally in manufacturing and supply chains, is set to deliver inflation moving down to 2%. I think what we're getting now is a shock coming from tariffs that's going to raise the run rate on U.S. inflation probably above 4% for 3 or 6 months. That's going to make it almost impossible for the Fed to think about a preemptive easing. You're going to need to see the break in the labor market to get the Fed to ease. And that, of course, would be a concern, because it would mean that the economy could already be sliding into recession.
That's the problem. Bruce, it's got to catch up to get your thoughts. Appreciate your time. As always, Bruce Kasman there of JPMorgan. That right there would be a big problem for the Federal Reserve.
4% going out for the next 3 to 6 months. I will say the market is really pricing this in. If you take a look at two-year break-even rates, the market implied inflation expectation over the next 2 years, it averages 3.3%. We are looking at, if you round up, that is the highest level going back 2 years. A lot of people are getting on board with that type of view.
Gold, record high again. We talked about it a few times already this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Lululemon shares are plunging more than 12% in the pre-market after the retailer delivered a disappointing outlook for the year. The CEO citing a cautious consumer due to geopolitical uncertainty and high inflation, joining a growing list of companies sounding the alarm on the consumer. Meanwhile, U.S. Secretary of State Marco Rubio says the Trump administration has so far revoked over 300 visas as it pushes to expel foreign citizens who protested against Israel. Among them are several international students who expressed support for Palestine. Their lawyers say the actions violate constitutional rights to free speech and due process. And King Charles was briefly hospitalized after suffering side effects from his cancer treatment. That's according to Buckingham Palace. The symptoms led to the 76-year-old to cancel arrangements to meet ambassadors in Birmingham. He has since returned to his official duties at his residence and was said to be feeling better. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, retaliation.
We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada.
That conversation up next. Mike Zezas of Morgan Stanley joins us on the other side. Live from New York City this morning. Good morning. A lot has been thrown at this equity market. We've had downgrades from Citi and HSBC, price target cuts on the S&P from Goldman, RBC and Barclays, and we're down again this morning by 0.1% on the S&P. On the Nasdaq 100, we're softer by 1/3%. Under surveillance this morning, retaliation.
We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. We will protect our workers and our industries during this difficult period.
So here's the latest this morning. Canadian Prime Minister Mark Carney vowing to retaliate against US tariffs. Carney telling reporters he and President Trump could speak as soon as today. Tyler Kendall joins us now for more from the White House. Tyler, are those two actually going to be speaking, and what about?
Well, John, maybe we'll get more of a readout on exactly what the agenda item will be, but it's definitely going to be about the future of tariff negotiations. This is going to be the first call between the two leaders since Mark Carney was sworn in as prime minister on March 14th amid what has been escalating rhetoric between the two leaders. And we have to keep in mind, Mark Carney really campaigned on countering President Trump. During his acceptance speech, he said that Canada was experiencing dark days brought on by a country they can no longer trust. He did appear to address those comments yesterday to reporters, saying that he does think that trust can be restored through what he called comprehensive negotiations, but that he doesn't think the relationship will ever get back to exactly what it was there. So still some, big questions going into this when it comes to Canada's retaliation to those reciprocal tariff plans. Carney did say that Ottawa is going to wait and hold off until they see the more comprehensive approach here that's tracking with what we're hearing from other allies, such as the European Union, which at this point has some fiery rhetoric, but is saying that it's still just too much uncertainty to know exactly how to respond. John, we did get a little bit of a preview, at least, to what to expect. Canada, under Justin Trudeau, had said that it was preparing retaliation to target Republican exports from Republican-held states moving forward.
Tyler, what's the sense of where negotiations are with all of these countries in terms of trying to get last-minute deals with the White House?
Right. Well, Annmarie, Bloomberg News actually had some pretty remarkable reporting after the EU trade chief was here in Washington earlier this week that said that the sense from EU officials was that they walked away from the conversation with senior administration officials that this White House didn't really want to negotiate until April 2nd had actually rolled around. And perhaps that's why we're seeing, even as some public concessions come forward, such as dropping tariffs on industrial goods or boosting U.S. LNG exports, we haven't really seen any tangible progress when it comes to what President Trump is going to end up putting on these countries come April 2nd. Now, President Trump this week did say that he plans to be fair and nice. He thinks a lot of people are going to be surprised by what he ends up implementing next week. But that really remains to be seen, particularly as we see some of these sector-specific tariffs, like the auto tariffs yesterday, really mark a real escalation in what has been this administration's approach.
Big time. Tyler, thank you. Tyler Kendall, down in the nation's capital in Washington, D.C. With us now, Michael Zezas of Morgan Stanley for an almost impossible conversation. Michael, good morning to you.
Hey, good morning.
Let's start with an almost impossible question. What are you expecting next week on April 2nd?
I'm not expecting a lot of clarity. I mean, I think really there's kind of two core questions to answer, or at least high-level questions. It's like, how much information are we actually going to get on April 2nd? And what level of kind of uncertainty comes with the answers to those questions, right? So on the one hand, if we were able to get some information that says, hey, here we're going to do reciprocal tariffs, here's the tariff differential we're applying to all different products across all different geographies, then that would be high level of certainty. And if it were just focused on the tariff differentials, not the VATs, not the non-tariff barriers, something that Trump's kind of hinted at, that's something that the market could probably latch onto in a positive way. Our economists have done work around that and said, hey, maybe this is actually, we're already at marked growth down substantially, but maybe this isn't that bad on top of that. If we get something that is a lot vaguer and sort of bigger in terms of big sort of product-specific tariffs, that's the scenario where we think you might have to start pricing in more significant growth downside into risk markets.
Tyler brought up a good point, which is that the Europeans came for a meeting and they were basically told, actually, let's start negotiations next week on April 2nd.
Yeah.
So is April 2nd actually, not to your point, you don't expect clarity. If it's the start of negotiations, how long is it going to take?
Yeah, I mean, that's part of the problem. Like, I think what we have seen with Mexico and Canada so far is potentially a preview of what now happens on a kind of much wider playing field with a much broader range of trading partners, right? So if you start from this, what might be a bit of a maximalist position, and then you have to kind of work back from there because you're putting other things on the table like exports, defense spending, and everything else, it could just be a long time before you kind of understand where the U.S. is willing to settle. And that uncertainty, there's already some of it baked into the market, but extending it further, obviously, this is part of the execution risk we talk about, whether or not you think the goals of what the administration is trying to achieve are kind of good goals or bad goals. There's a cost along the way, and there's execution risk that comes along with it, including the retaliation that we were just talking about. And we're going to just have to live through that, I think, for an extended period of time.
But that execution risk, at least I've spoken to trade negotiators in the past, say that gives them a tremendous amount of leverage with other nations at the table.
Yeah.
We do know Trump wants auto tariffs. At the same time, he doesn't want autos to pass on the cost of said tariffs, according to the Wall Street Journal.
Yeah.
Do you think there's going to be carve-outs for the autos, especially those that are operating under USMCA?
It's possible. You're already starting to see them, as they're getting into the details, explore this a little bit, particularly with the country of origin rules around the different equipment that actually goes in the cars. So, yeah, I think carve-outs are entirely possible, and that's generally the history. You apply a tariff, and then there are lots of exemptions that can come into play after that. The specific nature of them and how quickly that comes about and how quickly you get that clarity, I don't know. I think that all takes time.
So if you said that there's an implementation cost, what I'm trying to game out is, if we don't get clarity next week, is that a sell sign to you for risk assets? Is that sort of going back to what we just heard from Bruce Kasman, the sense that maybe this is a business unfriendly administration?
Yeah, I think the context around that lack of clarity matters. If it's lack of clarity paired with really strong rhetoric around, hey, we're going to do tariffs with, double-digit numbers kind of across the board, focused on some really important products, that's the type of thing that might cause investors to have to say, okay, we really have to think about the growth outlook picture differently. If the lack of clarity is kind of what we have right now, which is, well, we might be lenient and we're going to still focus on reciprocal and we're going to start here and have a discussion, we might be able to kind of extend this sentiment of, well, this is just a negotiation. We don't know exactly how bad it's going to be. Let's just kind of keep having to parse headlines and figure out what the heck is going on over the next few weeks.
How much time do you spend trying to understand the tariff headlines versus trying to understand the budget negotiations?
Well, I mean, a lot more in the tariff headlines right now because that's what clients are asking us about. The budget negotiations are extremely complicated, but I actually find them, because they're slower moving and because there are clear parameters around budget reconciliation, kind of much easier to work with, though the degree of difficulty is pretty high on both, in my view.
What's your timeline for the tax
budget? It's still end of year. We practice, so they're moving closer to kind of getting this budget resolution done. But even today, there's reporting that says, well, the way they're going to have to kind of hack it together for the Republicans in the House and the Senate to work is they're going to have different cost-cutting targets that are literally $1 trillion away from each other. And so at some point, they're still going to have to, amongst themselves, have this battle about, are they actually willing to cut all of this entitlement spending or not? We think ultimately they won't be, but that they're just delaying that really tough discussion. The closer they get it to the deadline at the end of the year, the more likely that discussion is able to be productive because you've got the pressure of that deadline forcing compromise.
Well, what about the debt ceiling, though? Isn't that supposed to be the pressure point to get it done before September?
Yeah, I think that's a fair point, but there's always ways you could deal with it outside of that whole process. And so ultimately, our expectation is that they actually end up having to deal with it outside of that process.
You excited for next week?
Yeah.
Big day.
Sure thing, yeah.
Michael Zezas of Morgan Stanley. I think we all are. April 2nd. Been waiting for this for a while, haven't we?
Absolutely. We've been waiting for it. I think I have been waiting for it since Donald Trump was announced the winner. When many people were talking about it's going to be tax cuts, deregulation, Trump trade. Well, the only thing he can do on his own is tariffs, and that might come first.
Liberation Day just around the corner, Bramo.
Okay. I mean, look, I think the problem is for a lot of people, they want to understand, just to Michael's point, what certainty can we ascribe to some of these tariff proposals? And if you cannot ascribe some certainty to what that structure is going to look like, what does that do to confidence that already has taken a hit from the lack of clarity, cloudy skies, in a dark room with a blindfold? I mean,
complex macro environment.
Uncertainty.
What do they say? Macro dynamics.
Yeah, macro dynamics are complicated.
Holding back footfall.
Yeah.
All of that stuff. Michael, thank you. It's good to see you.
Thank you.
As always, thank you. Up next on the programme, Congressman French Hill of Arkansas, as Republicans work to pass President Trump's tax agenda. Equities in a moment, negative by 0.1% on the S&P 500. 2 days of losses and just a little bit softer this morning on the Nasdaq 100. We are lower by 0.33%. With 2 hours until the cash open, here are your morning calls, your morning movers with Danny Berger. Hey, Danny.
Hey, John. Lulu continues to be one of the big underperformers this morning. In the pre-market session, down 12.33%. Downgrading their outlook for the year, the CEO specifically pointed to consumers, joining the list of companies that say macro uncertainties are pinching them. They also pointed to tariffs, saying that it will have some margin impact for them. So that's Lulu. But to the upside, related to tariffs as well, is Ferrari. We learned that they were going to be able to raise prices by about 10% for their U.S. cars, both Kepler and Barclays upgrading them, saying that they are in a rare position to be able to stay afloat and thrive under tariffs because of their customer base. So those shares up nearly 2%. Rounding things off this morning with some deal news, the deal that will not go away between U.S. Steel and Nippon Steel. Semaphore reporting that the talks have been revived. This time it is Nippon Steel going to the U.S. government, offering a bigger investment from $2.7 billion to as much as $7 billion. So there's some hope that this deal might actually happen. And because of that, U.S. Steel up nearly 5%, John.
Danny, thank you. Appreciate the update. Lisa, not impressed by that Ferrari news at all.
Oh, come on.
Customer base can just give a blank check.
I mean, honestly, wow, they actually have the power to raise prices. Who would have thunk it? This is not the demographic that we're talking about with potential price increases.
What demo are we talking to?
The people who are buying $30,000 cars and whether they can absorb $35,000, whether they can absorb a $5,000.
Maybe the Ferrari tariffs should be higher and, you know, $30,000 cars.
Now we're getting into it.
Should be
Nice.
lower. I'll let people who are above my pay grade decide that. I'm just saying I'm not, it's not exactly a sob story.
The congressman from Arkansas nodding along as you make that policy proposal. We'll get to that in a moment. Okay. On our radar this morning, Elon Musk saying his Doge cost-cutting team is looking to slash $1 trillion in government spending by the end of May. Musk aiming to cut 15% of annual spending, which amounted to $6.75 trillion in fiscal 24.
So at this moment, they're nowhere really near close to that. If you look at the Doge website, they have a lot of overstatements of what they have, but they talk about $22 billion in contract savings. Then they claim there's another $130 billion overall cost reductions, but those cost reductions are not itemized. So I think it's pretty important that if they want to sell this to the American people, at some point, Elon Musk and the Doge team, and we got an introduction to more than just Musk yesterday. There's a handful of them trying to talk about exactly what they're doing, which I think that transparency is useful. But we should see the itemization of these cuts.
Could be a busy day in Washington. This also on the radar. Canadian Prime Minister Mark Carney saying he will fight back against President Donald Trump's trade war, including fresh tariffs on the auto sector. The two are expected to speak potentially as soon as today.
That's going to be an important phone call, obviously, because Canada and the United States the rhetoric has been hot, and obviously with the tariffs, they're not going away. What I find interesting about this relationship now is Mark Carney talked about the future, and he said it's clear that the United States is no longer a reliable partner. Not now. He meant in the future. And obviously for these two countries, the trade integration is incredibly important. Can he potentially get a deal for Canada before Liberation Day?
Even if he could, I'm not sure he'd take one. Electoral politics. It is not in the Prime Minister's interest right now to get along with the President of the United States. Now, you might disagree about whether that should be the case, shouldn't be the case. That is the case. That is the case right now for Prime Minister Carney.
It is the reason why he is the Prime Minister, because otherwise the Conservative Party would have won. The reason why the rhetoric is so fiery, that the old relationship with the United States is over in terms of what it used to be, speaks to the increasing ire. Did you see that the bookings by Canadians to the United States for travel have fallen by 70% over the past couple of months? People don't want to come here.
At the same time, he's not just a prime minister. He's a former central banker. I think he understands that doing a deal would maybe be helpful, even if it's not politically as great, maybe to keep his prime minister role. He does know the repercussions on the Canadian economy is going to be worse than on the U.S. economy.
He's got someone to blame. I think he's got an election to win. The fact that we're not talking about Poilievre, the Conservative leader who had a 20-point lead a few months ago, where is he? Hardly being talked about. He had a huge lead. This tariff spat has completely upended that election.
Yeah, and it's sort of like a reversal of South Park. Blame Canada. Now it's like blame the United States. And so it really is a good rallying cry.
Nice, I like that. People are going to run with that, Okay. Let's finish on this. The Trump administration pushing to control all major infrastructure and mineral investments in Ukraine. Bloomberg obtaining a document outlining a so-called right of first offer that would vastly expand America's influence compared to the European Union.
I'm not really surprised about this because obviously Zelensky left the White House without signing that mineral deal, and I think then the cost just went up for what the U.S. was willing to get from Ukraine, the extraction. What you hear from this administration is that they think that doing economic deals could potentially help foster the protection, the security that Ukraine is looking for.
Let's get to this story and let's get to our guest. Senate Republicans working on changes to the House GOP tax plan, looking to require fewer cuts in Medicaid benefits for the poor and disabled. The move aiming to appease members of the party worried about public backlash. I'm pleased to say that a good friend of this programme, a good friend of ours, the Congressman from Arkansas, French Hill, joins us now for more. Congressman, good to see you, sir.
Jonathan, great to be with you and Lisa and Anne-Marie. Always good to be back in New York.
Is it turning out to be as much fun as you thought it would be down in Washington?
Every day is a joy.
April 2nd, how much of a joy is that going to be?
I'm just glad it's not April 1st, because that would even increase the uncertainty even more. I mean, actually.
What are your constituents telling you about what's happening in Arkansas on the ground?
Yeah, look, on the relations to tariffs, about 30% of our output in Arkansas goes to Mexico or Canada. And that's food and manufactured goods and back and forth. And then you have the North American Free Trade Agreement, now under USMCA, that was crafted to make North America the destination for manufacturing. So for 30 years, it's been knitted together. And so I think the first thing that I'm hearing is certainty, and just lay out the plan on how you want to use tariffs to open up more markets for Americans, have reciprocity on fairness in certain markets that are highly disproportionate treatment, like India, for example. But when it comes to North America, let's renegotiate USMCA. If you want to limit certain inputs from China into Canada, Mexico, or the United States, you can do that in the agreement. Those countries can do that on an input basis. If you want to have the American manufactured content higher, you could negotiate to do that, as President Trump successfully did last time he was president on the North American auto content. He got more American content. So I think it's best to tackle this Canadian and Mexican issue inside a new and revised USMCA.
But USMCA was done under Trump. It replaced NAFTA.
Right.
So you want USMCA Part 2. Do you think that's what he's getting at, Donald Trump here, the president? He's getting at the start, bringing those 2026 talks up into the mid-2025?
Yeah, potentially. And I think that's not wrong thinking on his part. If you're concerned about Chinese dumping through transshipment of steel, for example, into Canada or Mexico, let's deal with that inside the agreement. Let's have Mexico deal with that in their own trade policy on inputs coming into the country. Because that's how I think you have a more robust, competitive international system where manufacturing is at the heart of America. I think President Trump strategically in trade diplomacy, I'd like to see more things made in America. That takes time to do. It's not overnight. We had steel and aluminum tariffs, for the past 5 or 6 years, and they haven't, been overnight changes across the board.
Walmart is headquartered in your state. They went to China and said, look, we're dealing with tariffs. You're going to have to eat some of this cost. And the Chinese are saying no. Are you concerned about the cost being passed on to consumers?
I am when I don't know what the strategy is. This is the whole point. You have trade diplomacy on using trade as a sanction potential, like you saw the president do on Colombia on repatriation of immigrants. You had trade used for reciprocity to bring down actual barriers that benefit actually both countries potentially over time. And we did that successfully for 40 years. We did it targeted. When I was in the White House working during the Bush administration, we used Section 301 to target bad activities by principally then Japan to open those markets doing this kind of tariff activity and limitation on imports to the U.S. So you can do that in a classic trade diplomacy situation. But when you have across the board and it's not clear on what the time frame is for the increased production in the U.S., I think that's the challenging part.
But is it your sense when you speak to the White House that April 2nd is the start of negotiations, that at the end of the day, the president is a deal maker and wants to get deals done?
Well, I hear from my colleagues on the House, they want clarity like the American business wants. So you tell us what components and what timeframes you want to do trade diplomacy, you want to use reciprocity, you want to protect certain industries in the U.S. where you want to have achievable gains in production here. But when it comes to autos, which is the most important topic of the day, I think that's best done through advancing changes to the USMCA that President Trump led successfully with the Mexicans and the Canadians in his first term.
The market's also looking for clarity on all of Trump's proposals, especially tax cuts. The Senate, the Republicans, Eric Wasson, our reporter in Washington, D.C., is talking about how they want fewer cuts to Medicaid health benefits for the poor, disabled, which would be different from what the House is talking about. Do you think House Republicans, Senate Republicans can come to an agreement on how much can be cut?
I do. I think we'll come to an agreement. I think we can come to an agreement rather quickly on a joint House and Senate resolution for reconciliation so the committees can get to work. And I just referred to the Wall Street Journal story today talking about duplicate payments in Medicaid across the states and how large that number is. House Republicans are looking ways to improve Medicaid, focus Medicaid on the most vulnerable, the young, the poor, the disabled, and tried to wring costs out of the systems. Democrats, I think, in a political charge are, well, you're going to cut benefits for Medicaid. That's an assumption by Democrats politically.
Well, because the math doesn't work when you're talking about $880
And also,
billion.
that's the charge for the whole committee.
Right,
Yeah.
but most of that money goes to Medicare, no?
Right, but look at the numbers, and I think that's what the House and Senate want to do. Let's get to a Senate resolution. And let's let these committees work to mark those bills up to find the savings that we can produce.
Besides the extension of TCJA, what other tax cuts do you think are actually feasible? The president has talked about no tax on Social Security, no tax on tips. Just this week, no tax on auto loans apparently is being thrown out there and he's flirting with. What actually can get passed?
Well, this is the beauty of the reconciliation process because the president puts his plan out there, his best ideas, what he wants to try to accomplish. And then the House and Senate have to come together and figure out what we can do in the context of that budget resolution. Can we find the cuts? Can we find the offset? Do we agree in the House and Senate on the economic forecasts? And so I won't prejudge what the possibilities are. I just know how hard the work is going to be. I want to put an emphasis on things that grow the economy. So if we have to narrow the focus on what amount of tax cuts we're going to have. Let's focus on ones that produce production, more jobs, faster economic growth.
Do tariffs increase revenues and turbocharge growth?
Again, this depends on the strategy, Lisa. You can have an across-the-board modest tariff that might raise revenue and not impact growth economically. But what is your goal? Is it reciprocity? Is it market opening in new countries? Is it level of the playing field, or is it increasing production in the U.S.? Those things are sometimes in conflict.
What number are you penciling in for the tariff revenue to offset some of the cuts?
Right. So in Congress, we're actually not penciling in tariff revenue because it's not counted by this Congressional Budget Office as an offset, which doesn't mean we can't count it. Like if there was a strategy and it laid out, the two budget committees could agree. We will accept some revenue from projected tariffs in the revenue estimates in the reconciliation package. But we're not, as of now, counting that. That's a hypothetical that we're actually not counting on. Right?
Has Walmart been in touch? I imagine they must have reached out to you and other representatives of Arkansas. How upset are they about this?
Well, they want, I think, so many businesses, and they report on your broadcast on a regular basis, they can live with certain things that they know what the plan is. And so Walmart's concerned about the number one thing they think about every single day, which is the American family they serve. And they want to make sure that that can be done in an affordable way. That's their goal in life. So this could interfere with that. But we need to wait and see what the ultimate goal is.
Do you think the White House appreciates that? Because we hear this every single day. And we've said on this program, confidence coming into 25 was sky high. We wanted to see that sky-high confidence translate into hiring, into investment.
Right.
And the lack of clarity, the lack of certainty, it's really held things back, and you see that in the sentiment surveys now. Does the White House, in your opinion, sort of understand that? The lack of certainty, the lack of clarity is holding this economy back.
I certainly think Treasury Secretary Bessent and National Economic Council leader Hassett know that. They're very experienced in economic policy making. And my view is you've got I think, clarity about right-sizing regulatory costs in the economy. You've got clarity about trying to reduce the bureaucracy in the government. You've got clarity on where we want to go on tax policy. We need an equal amount of clarity on the strategy in and around tariffs and increasing manufacturing here. President Trump's big picture point is a good one. But you've got to develop a workable strategy to do that. And I think that's what the role of the Treasury Secretary, the Commerce Secretary, and the National Economic Advisor, that's their principal mission.
Congresswoman Elise Stefanik is going to be staying put in Washington, D.C., not coming to New York to work at the UN. Do you think that's an admission by the White House that they're nervous about getting this tax bill done through Congress? They have the votes?
Well, it surprised me. I'll be candid. I think Elise was an outstanding member of our leadership team. We welcome her back to the Congress, but I also thought she was going to be an exceptionally well-trained and qualified ambassador for the president at the United Nations. It could signal that. I think President Trump's own quote says we need to make sure we have the votes in the House. So if you consider that an admission, we welcome her back. I think it says that maybe replacing her with a Republican they think might be tough in New York as a political strategy, which is that's been a red district, but you know that may indicate that. And we need every vote we have. We have the most narrow margin. Mike Johnson has the most narrow margin since World War I, and so we don't want to have a gap there. And when we passed Tax Cuts and Jobs Act back in President Trump's first term, I think some 20 Republicans voted no. So we don't have the luxury of that this time.
Congressman, we always appreciate your time. It's good to see you.
Great to be with all of you.
Thank you, sir. Congressman French Hill, and also the chair of the House Financial Services Committee. Equity futures right now on the S&P slightly softer. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. A 7.7 magnitude earthquake struck Myanmar, causing buildings to shake and triggering evacuations in Vietnam and Thailand. And in Bangkok, a 30-story building under construction collapsed, killing 3 people. The quake was the strongest worldwide since 2023. Meanwhile, yet another record for gold as concerns mount over President Trump's tariffs. Gold hit an all-time high of more than $3,085 an ounce today, though it has since weakened. This coming as Goldman Sachs raises its forecasting. It expects gold to hit $3,300 an ounce by year end. And in March Madness, unfortunately for the congressman, Arkansas's title run came to an end after a thrilling overtime loss to Texas Tech. Meanwhile, Florida beat Maryland and Duke took down Arizona behind a 30-point performance from Cooper Flagg. The action picks up tonight with Ole Miss versus Michigan State, and number 1 seeds Houston and Auburn tip off against Purdue and Michigan. That's your Bloomberg brief. John?
Yahara, thank you. Didn't even get a mention there, French. Not even a shout out.
I was going to burst into tears on national television. I stayed up till 1 o'clock here.
Oh, brutal.
Hoping my Hogs would pull it out, but congratulations to the Red Raiders.
Who's scheduling these games this late at night?
In California late at night, it's just...
Can we legislate for that? Why have we got this California bias?
People debate about daylight savings time. Let me tell you something. Central time is God's time, and you just can't operate outside Central time.
You tell him. All right. It's good to see you, Congressman. Thank you. Up next, debating the T word.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory.
I try not to use that word anymore. I will just say that.
Up next on the program, Earl Davis of BMO from New York. This is Bloomberg. We're going to solve this, addressing the Liberals' bias on sports scheduling.
You're going to lobby a congressman one at a time.
That's what we're doing.
Literally.
We're going to make it happen over time.
I don't agree with CEP,
because these studios are based on the West Coast and they're making us stay up late to watch sport. Sunday night to watch March Madness.
Yeah,
Unbelievable, unthinkable stuff.
Most people don't wake up at 3.
Can they stay up till 11 to watch the basketball? Midnight,
it's not a problem. Yeah, because they wake up at 7. It's okay.
Silly.
The poor congressman was up till 1 a.m. He had to be on TV the next day.
Do you know, I've enjoyed so much watching Premier League football in the UK at like 7:30 in the morning. It's perfect.
Oh, good. I'm glad.
Wake up, put the sport on. All right, let's move on. Futures on the S&P, negative by 0.1%. Under surveillance this morning. We're debating the T word.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory.
I try not to use that word anymore. I will just say that.
It looks inevitable that tariffs are going to increase inflation in the near term.
I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary.
So let's get to the take from Earl Davis of BMO. This is what he's got to say. Transitory tariff inflation is true, but tight employment is where inflation will come from. This, ironically, has brought inflation expectations back to the forefront. Earl joins us now for more. Welcome to the programme, sir. We've been debating this all week for the last 2 weeks, in fact, ever since we heard from the chairman of the Federal Reserve in that news conference. How fertile is this environment for second-round effects of inflationary impacts from tariffs?
It's extremely fertile. And the reason why it's extremely fertile, it's not necessarily about tariffs or actual inflation. It's about inflation expectations. And given that the Fed was unable to get inflation back to target during this downturn in inflation, let's call it 2%, you know what? It's easy for those expectations to become unanchored. And we are seeing a drift higher. They're still anchored, but it's easy for them to become unanchored. So for that reason, we think possible inflation and rise in inflation expectations, the ground is extremely fertile.
So do you think that this is a terrible time to buy long-term bonds at a time when just a couple months ago you thought it was actually a good time?
Actually, the opposite, and I'll walk you through. Right now, we're slightly underweight bonds. We believe we could go to 450. But once we hit 450 to 5%, we buy. And this is why you have to look at the mathematics of bonds. So if you look at the Bloomberg U.S. Aggregate Index, which is a bond index mixed of treasuries and corporate bonds, the duration on that's 6%, 6 years. The yield is 4.7%. So if you get an instantaneous 100 basis point rise in interest rates tomorrow, instantaneous, you will be down 6% market value, but you will make back all of your money in 1.1 years because your coupon will now be 5.7%. Above 4.5, you make back all your money in 1 year. And you're up. So if you tell me I could buy bonds and be protected for an instantaneous 100 basis point move, I'm buying. And that's what active managers do. Having said that, we're still aware of market movements and we want to outperform. So that's why we are slightly underweight now, but we have levels at which we buy.
Earl, this is the most bond conversation ever. Actually, check the math. I am curious, though, how much this is predicated on the idea that it is a better alternative than risk assets simply because there is this uncertainty that could weigh on growth.
I wouldn't say it's a better alternative. It's part of an overall diversified portfolio, and it provides. And so the reason why you want to own bonds is two reasons. One, the coupon, and as I said, in the aggregate, it's close to 5%, which is very attractive, much higher than it's been since the global financial crisis in general. We're in the upper end of that range. And your flight to quality, as we've seen why bond yields have rallied now, in case you do get a severe sell-off in risk assets, which we're not anticipating, but you have it for those two reasons. So because of that, and because you're making more than inflation, you're getting a real return, it's an ideal thing to increase the allocation to in an overall portfolio.
Earl, equity investors just want to make it really simple. Can you tell them that if the economy gets in trouble, this Federal Reserve will be in a position to cut interest rates?
Oh, yeah, largely so. In regards to, we could go back to neutral, they call 3%. We could go easily into easing territory. I want to put a caveat on that, though. Although I think they've opened up the door to cutting rates, if they cut rates too early, let's call it the first half of the year, I think bond yields could actually go much higher. And the reason why they go much higher is because the market could say, we no longer have discipline on monetary policy if the data doesn't support the cuts. So the data has to support the cuts. We have to see a trend of weakening growth. We have to see a trend of higher unemployment. If they cut without those trends, they do risk the bond vigilantes taking over. So that's a big caveat there in regards to the timing of eases.
Earl, this was a clinic. It's good to hear from you. Earl Davis there of BMO. We got a flavour of that at the end of last year, didn't we?
Yeah, very much so. So they want to avoid that, and yet they're kind of between a rock and a hard place.
Up next on the programme, Kevin Gordon of Charles Schwab, Daniel Roeska of Bernstein, former St. Louis Fed President Jim Bullard, and Mike Contopoulos of Richard Bernstein Advisors. The third hour of Bloomberg Surveillance, just around the corner.
Trade and tariff cannot be taken lightly.
The administration is moving forward with fairly aggressive tariffs.
We have now the highest effective tariff rate we've had since the 1940s.
What is the probability that beyond next week we're putting completely to rest the tariff issue? That probability is probably very, very low.
April 2nd is not the beginning of the end. It's the beginning, and there's a long way to go before that end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores. Equity futures on the S&P 500 negative this morning by 1/10%. Through Thursday, just about poised for a second week of gains on the benchmark on the S&P 500. On the Nasdaq, we're down by 0.2%. Important data point later this hour, 8:30 Eastern Time. Another read on inflation in America. Later on this morning at 10 a.m., another read on consumer confidence. And consumers haven't been too confident.
Certainly not in the surveys where it seems to be that everyone is expecting Armageddon. If you take a look at the actual data, it hasn't been as bad when you take a look at what they've been doing. That's the reason why the 1-2 punch of personal income and personal spending, and then the survey is going to be really important at a time when market-based inflation expectations have been creeping up. And that is the reason why maybe on the margins people will be paying that much more attention.
I'm with you. Spending. Retail sales. This is so important because there seems to be a spread, a difference between how people feel and what they're doing. But when you listen to the consumer-facing companies, they're telling you that they're not doing as much as they used to. Lulu's down this morning by close to 12%, and they're not alone. We've heard this from Delta Airlines. We've heard this from others.
And this is the reason why earnings are going to be so important as a gut check for that sentiment and how much is coming through. We do wonder about sandbagging. How much is Lulu realizing that not everybody wants to wear spandex around town and that maybe they need to loosen it up? At the same time, there has been a consistent trend across consumer-facing companies, and that is the reason why it's getting people's attention.
They're worried about tariffs without saying they're worried about tariffs. Coming up with this McKinsey-esque language to say we're worried about tariffs. Next week, a lot of you I know worried about what we might hear on the tariff front by the President of the United States. April 2nd, Liberation Day, is coming up fast.
It's coming up fast, and potentially we'll get some leaks of the president talking about tariffs ahead of next week, ahead of Wednesday. So you're going into the weekend really needing to be informed. When it comes to that McKinsey-esque jargon, there continues to be considerable uncertainty driven by macro and geopolitical circumstances. That being said, remain focused on what we can control, a.k.a. every single company is trying to understand and get clarity from what the tariff and trade policy is going to be in the United States next week. But what do we hear from analysts? It's just the start.
When you don't have any control, it's hard to feel stable. It's hard to feel like you actually have a sense of what's going to happen.
When you talk about the economy, you do realize it sounds like a therapy session.
Well, that's what I was talking about with Tom Barkin coming out saying policy changes have created, quote, a sense of instability
You should charge
in the
for
business
this.
community and could quiet demand among consumers, because when you feel unstable, you just go quiet.
How much is it for an hour? Sit down with Bramo, bit of therapy.
You can get it
work
for free.
it out.
Bloomberg Surveillance every morning.
Find some stability with Lisa. Equity futures on the S&P negative by 1/10%. Coming up this hour, Kevin Gardner of Charles Schwab as stocks look to recover from 2 days of declines. Daniel Roeska of Bernstein calling Tesla the clear auto tariff winner. And we'll speak to the former St. Louis Fed President Jim Bullard reacting to the latest economic data. That data 26 minutes away. We begin this hour with stocks little changed as traders brace for President Trump's Liberation Day tariffs. Kevin Gardner of Charles Schwab writing, April 2nd is just a continuation of the beginning. The reality is no one knows what's going to happen. There is simply no conviction to be had on trade. Kevin joins us now for more. Kevin, good morning.
Good morning.
We'll get it together for you, don't worry. If you can't have conviction for next week, how much conviction can you have in markets?
I think it's tough. I mean, especially if your market call is tied to anything trade or tariff related, which it almost has to be, at this point at this stage in the game. So, our sort of feeling around markets for this year, and I know we've talked about this a lot, our call being you're probably going to see a lot more index level volatility relative to last year, which has already been the case. We're almost 3 months in. That's just one quarter, and you've already gone through a full-blown correction for the S&P, for the Nasdaq, almost for the Dow. So the low conviction environment is one where you just want to cling to quality and make sure that you're not sacrificing anything, especially because some of the earnings reports and transcripts that you guys are covering this morning, a lot more cracks are now forming within the earnings picture, not at the overall aggregate level, but you do have to wonder at some point how much of this is just a collection of idiosyncratic risks for certain companies and then just that forming into and becoming a macro trend. That really becomes a dominant issue, and why our kind of hideout and high quality theme has been so persistent for the past couple of years.
Is that a distinction without a difference, that final point?
It gets tough. I think that what was, and I'll phrase it with some sort of data points around it, where if you think about what was so interesting to us for the fourth quarter earnings season, even though you went from a blended growth rate throughout that reporting season from around 8% at the beginning to 17, 18% by the end, as that was happening, every single quarter for 2025, all those estimates got cut. So you didn't have any pickup, and there was no almost relief on the estimate front, which is, typical of what you see at this point of the earnings cycle. But you would at least start to see maybe some context around, hey, even though, our earnings estimates are getting cut, guidance is still relatively strong. We're still going to see relatively strong revenue growth. That's not happening as much anymore. You layer on anything from a tariff standpoint, especially for a lot of industries like autos in particular that operating with thin margins, it's a tough scenario.
Is the concept of quality changing? And I ask this because utilities were boosted by the AI trade. Healthcare was boosted by a lot of government spending. You have all of these sectors that have traditionally been called quality that are coming under some pressure.
Yeah, what's tough about this is that sometimes, and especially in this cycle, quality and momentum go hand in hand, meaning, for a good chunk of this cycle, and I still would argue the case today, whether you're looking at the Mag 7, the 10 largest companies, even if you brought it out to sectors like tech or communication services, a lot of the fundamentals are still relatively strong. It's just unfortunate that, especially for a group like the Mag 7, they got caught up in the momentum trade. So when you get that unwinded momentum, it exacerbates the move to the downside, which is exactly what we've seen. I mean, the Mag 7 have gone into a technical bear market just this year. But there doesn't mean that the quality has just completely flipped overnight and they're now these, junk companies. So I think that is the tough part about, yes, still wanting to maintain exposure to quality, but understanding that if they get caught up as a momentum trade and if they dominate the momentum factor, then they're going to get caught up in a sell-off and get hit more to the downside relative to the rest of the market.
When you start describing this to clients who are concerned, their eyes glaze over and say, just put me in gold?
Well, I have gotten more questions on that now, especially with all the events that I've gone to, over the past few weeks. But no, there's still definitely, I think, a bias to stay in the equity market. But and I know we've talked about this a lot just this year, just discussing the idea of lengthening time horizons and making sure that you're not trying to make knee-jerk reactions and knee-jerk decisions based on what's going on a day-to-day basis. Because as we all know, and as you pulled from the quote, nobody knows what's going to happen. I mean, really, everything it's such a low conviction environment. It's really hard to find another period that's similar to this in terms of conviction.
Is there a bias to leave the U.S. still?
I would say still not. That hasn't been the case in our client base. It's been a long, process of trying to, at least just kind of espouse the idea that diversification outside of the U.S. is a good way to go. And our international strategists and team have been, pounding the table on that for the past year. It's been a hard sell up until maybe January 20th of this year when things started to flip pretty quickly. But you're starting to see a little bit more interest, and that's actually that's being reflected now in flow data, which I think is kind of that next step of the phase. Everything was sort of attitudinal at first. Now it's starting to filter over into the behavioral as well.
Reading through your notes, you start by talking about April 2nd and this uncertainty, and then you end on all roads lead to labor market. Mm-hmm. When will all of this hit the jobs market?
I think a lot of that is going to show up. What you have to wait to see if it happens is that mechanism, that connection between anything tariff-related raising prices and then leading to some sort of consumer backlash. Because you have to keep in mind, I mean, the consumer is in a very different spot today than it was a few years ago, even when we were going through that massive inflation spike in 21 into 22. That was happening at the same time that the labor market was rebounding and strengthening. Right now, the labor market is not strengthening. It's yes, in a relatively good spot, but it's also in a relatively fragile spot. You don't want to have to, take a sledgehammer to any parts of it and see if it's, working or to see how strong it is, because there are cracks that have formed. So I think that that's kind of the next big phase or the next big test for this, especially because basically all of the soft data has rolled over sharply, not just on the consumer side, but also on the business side. So if you start to see a hit to real disposable income growth, start to see a hit to spending, that brings revenues down even more for businesses. They're already in a tougher spot. So you can see how the domino effect happens from there.
John, Kevin was talking about how it's a hard sell to go to Europe as an investor, not as a tourist. But I am curious about how important it is to look at these flows. He mentioned flows. You saw the largest outflows coming from U.S. equity funds over the past week. $20.3 billion of withdrawals. Guess who saw inflows? The seventh consecutive week of inflows. It was the European equity funds, totaling around $3 billion. Again, we are starting to see it bleed into market performance.
Careful what you wish for. I go back to the note from Peter Schiff of Economy from last weekend, and he raised a really important question regarding April 2nd. Careful what you wish for. We'll get certainty on April 2nd. Is that the kind of certainty that European investors will want to see? Are they whistling past the graveyard?
Well, you'll get certainty to some degree, but who's to say that April 3rd it doesn't all change? I mean, nobody knows that. And I think even with April 2nd, you look at the laundry list of what has to be done. For a small team, relatively small team at USTR to go country by country, maybe product by product, all through those lists, it's a heavy lift. If they come out with that, great. But at the same time, if you go through another wave of uncertainty, and if April 2nd becomes then May 5th or June 10th,
it's true,
or August 5th, I mean, it really is now the policy being uncertainty. Uncertainty is the policy to some extent.
This is what Max Kenner of HSBC said. He said uncertainty can persist, but I think as an investor, you have to think about the balance of risks. One market is up double digits this year. Yeah. The other market has fallen double digits this year. One market has started to internalise the risk associated with these policies. The other market, has it started to internalise the risk associated with these policies?
I will say, to some extent, you can see this actually at a sector level where there is some consistency and overlap. And one of our overweights, one of two that we have at the sector level in the U.S. is financials. And financials globally, as a story of leadership, has actually been pretty consistent. The double-digit declines and the majority of the declines here, so far in magnitude and in mathematical terms, when you look at the weightings in the index, has been tech-driven, tech, communication services, consumer discretionary. If you start to look at the other parts of the market, whether it's financials or utilities that have maintained some kind of leadership status, especially if you look at the percentage of companies that are above their 200-day moving average, it's actually been relatively strong.
Don't you think that begs the question as to whether this has anything to do with tariffs at all? Well, the correction that we have seen on the S&P is dominated so much by U.S. tech firms.
Yeah, there's certainly a tie-in with tech that's tariff-related. But actually, if you look at the correction that we had from February 19th to the March 13th low, at the industry levels, if you look at all, I think, 74 industries, retail, autos, some leisure parts of the market, they were at the bottom of the leaderboard. So it is still a tariff story, but it's hard to see when, the tech and tech-adjacent parts of the market are just so large, and when that momentum unwind, and now the AI sort of theme and narrative is coming a little bit more into question.
It's been absolutely battered. Kevin, it's good to see you, sir.
Good to see you.
Appreciate your time. Thank you. Kevin Gordon there of Charles Schwab. Just getting a headline I wanted to share with you from CBC Radio Canada that Prime Minister Carney and President Donald Trump will take a call, and that call will take place later on this morning. So a bit of confirmation again on that front.
Right, that this was, they were talking about how they were going to set up this call. The Prime Minister coming out saying that they will retaliate against these tariffs. Obviously, I think this entire conversation is going to be about trade ahead of next week.
Without a doubt, you'd expect. Equity futures right now in the S&P down by about 0.2%. Not the congratulatory call from the President to the Prime Minister to say, congratulations.
I don't know if there's going to be a congratulations on this one.
Let's get you an update on stories elsewhere. To be a fly on the wall. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. The U.S. Defense Department says it will terminate a plan to use Oracle software to manage its civilian workforce. It's the Pentagon's latest move to cut costs. The announcement comes after Defense Secretary Pete Hegseth said the program and other contracts are 6 years behind schedule and more than $280 million over budget. Oracle shares are lower 1.4%. Meanwhile, Elon Musk says he plans to slash $1 trillion in government spending by the end of May. Musk told Fox News he doesn't think the savings will affect critical government services. The Doge website so far lists about $22 billion in contract savings, while claiming $130 billion in unspecified cost reductions. And in sports, Novak Djokovic made history in Miami. His victory over Sebastian Korda in straight sets makes him the oldest player to reach an ATP Masters semifinal. The 37-year-old will now play for his 7th Miami Open title, with his semifinal match against Grigor Dimitrov getting underway later today. That's your Bloomberg Brief. John?
Yahara, thank you. Tough crowd this morning. Unhappy about the lack of baseball coverage?
It's opening day yesterday, and the Yankees won. Why are we doing tennis?
He gives us hope.
There you go. You've got some space. You want to talk about it some more? Is that it?
No, that's fine. We won
Yankees
4-2 versus the Brewers.
What happened to the Mets?
I believe lost. Sorry, Lisa.
Is that why you wanted to talk about this?
Well,
just some crosstown shade.
Multiple reasons. Multiple reasons.
We're running out of time.
For the people of Queens. OK. Up next on the programme, the Morning Calls Plus, Daniel Roeska of Bernstein naming Tesla the clear auto tariff winner. That conversation up next. The The open about 1 hour and 13 minutes away. Equity futures here negative by close to 0.2% on the S&P, down by almost a third on the Nasdaq. That's the price action. Let's get to some morning calls. First up, Raymond James downgrading Lulu to market perform, citing the uncertain consumer. That stock is down by 11%. Your second call from Citi, raising its price target on Southwest to 30, citing moves to reduce seat mile costs. That stock still softer by 0.4. And finally, Deutsche Bank cutting its price target on Tesla to 345 ahead of the company's Q1 deliveries, citing weaker demand trends. That stock is bouncing back by 1.5%. Sticking with Tesla, Daniel Roeska of Bernstein writing this about auto tariffs. Tesla wins, Detroit bleeds. Tesla is the clear structural winner. For everyone else, this is a margin reset. Daniel joins us around the table. Daniel, good morning. Good to see you. What a time for you and the team to try and work through this, eh?
Little sleep.
Do you know what is exempted and what isn't going into next week?
On vehicles that are imported, we have a pretty clear idea. On parts that are imported, we have not, because the Annex 1 hasn't been published yet.
So we don't even know what this means for individual companies in many ways.
On a high level, I think we can get a good sense, but in the detail, if you ask me, can you give me the cent value? The answer is no.
Do you think autos in the end that are USMCA compliant will get exemptions?
Yeah, I think the U.S. content will get exemptions. And I think that's where the big debate is right now, how much U.S. content actually is within the cars. It's one of the reasons we think Tesla, at least for their U.S. sales, has a leg up, because about 60% of their content is from the U.S.
So do you think the auto companies will actually, at least for the production of those parts, if they're paying tariffs on them, will they try to get U.S. suppliers? Will they try to move more back into America? Or do they just eat the cost and pay the tariff?
You need to try to get the supply chain back right now. So the incentive is very clear to maximize your U.S. content, but everybody's trying to do that. And it's not like the U.S. suppliers are just duplicating a number. I'm pretty sure that by 7 p.m. on Wednesday, the entire U.S. supplier capacity was bought up already. And so it's going to be really difficult to really change that percentage by a large degree.
The way that you frame this, I think, is important, that for the rest of the auto industry, it's a margin reset. And this comes at a time where President Trump, reportedly by the Wall Street Journal, threatened auto executives by saying, you're not going to pass this along to consumers or else. And there is this feeling, what do we do? Can they afford to absorb the margin differential and not just pass it along to the consumer?
No, let's put some numbers on this. So if what was announced on Wednesday gets rolled out without any changes to supply chains, the U.S. auto industry will have to pay $110 billion in tariffs. The entire gross profit of the U.S. market is $140. There is no way this is happening without raising prices.
So which prices go up the most? We were talking about Ferrari. We're all crying for Ferrari and the fact that they can raise their prices. There isn't the same kind of luxury in many ways in a lot of the other manufacturers. So what are we looking at in terms of who has the leverage and how much prices are likely to go up?
So on average, we think prices are going to go up by about 7%. That gives you a volume hit of about 5%. So it's a good equal balance. Half of the tariffs paid by the consumer, half of it paid by the companies, basically. And the ones that will bleed most, well, actually it's not Detroit, it's the foreign ones. So everybody who's making cars around the U.S., so Japan, Korea, Europe, that's really where you'll probably see the highest price rises and hence also the biggest volume decline. And probably into 26, that maybe gives you an opportunity for Detroit to actually capture some share.
So price up, demand down initially. Does that make it harder to invest in the way that the administration would like them to invest domestically?
I think it's impossible for them to invest in the way the administration would like to invest, because what the administration is saying, please build more factories in the U.S. One auto factory, $6 billion, short, quick check. That's not going to happen. And
do you think the White House will reverse course the way we have seen Trump reverse prior?
I'm not certain on that, because what we're seeing in this executive order, it's a lot more detailed, and the way they've gone about it is much more structured than 6 weeks ago. And so there is much more purpose in this, which has led us to say, look, the likelihood that this stays is a lot higher than it was, and the market certainly is starting to agree. You saw the move on GM. GM's down another, I think, 150 bips this morning in pre-market. And so the sentiment of market that was, oh, this is only going to last 4 to 6 weeks, is shifting to this will stick around. And I think the next straw investors are clinging to is maybe the Trump administration, as a trade-off for that price guarantee, will give more USMCA exclusions somehow and benefit the U.S.
When it comes to what does the auto companies do in terms of protect their margins, at some point, do you expect layoffs?
No, because remember, not in the U.S., right? Because every car you make in the U.S. has a fairly high or relatively higher domestic content than everything that's around the U.S. And so production is going to centralize to the U.S., so no layoffs. But that doesn't mean you wouldn't see staff reductions in Mexico or Canada or other regions around the U.S. that sell into the U.S.
So let's go to the other part of this equation. You said Tesla wins, Detroit bleeds, as John was reading out. And I am curious about the Tesla winning part of this. Why are they winning? And putting aside conspiracy theories, because frankly, that was kind of put aside, at least by the president. And Tesla does have a big manufacturing base in the United States. How much does it actually benefit?
Yeah. So while we don't cover Tesla right now, we looked at the impact of the tariffs on their U.S. business. And Tesla makes 100% of the cars they sell in the U.S. And those cars have 60% U.S. domestic content. It's the highest share of U.S. domestic content in the U.S. auto manufacturing industry. And that means the tariffs they'll have to pay for the parts they import will be the lowest. And so if we expect that the overall sector rises prices by about 5%, we think Tesla's cost for U.S. built cars only goes up 4 to 5, which means they actually have a margin expansion. It's the only company in our analysis that has a margin expansion on the back of all of this. That's where the comment came from.
Have you made any assumptions on how others will retaliate? What this could mean for European markets, Chinese markets?
No, not yet. If I think of our Detroit 3, I'm a little bit more relaxed, right? Because they don't export to Europe. Nobody exports to Europe from the U.S. And so retaliation, at least on the auto sector, from a European point of view, would not be too detrimental.
Where does it leave that BMW factory in South Carolina? How much exporting do they do?
That's the only one, right?
Just that single one?
40%. You've got a little bit of a Volvo in South Carolina as well.
And Mercedes-Benz.
Well, Mercedes-Benz mainly manufactures for the U.S., so the Alabama factory is fairly low. The export percentage is fairly low. But the big challenge, of course, for these factories in the U.S. is the main thing they import is engines. They don't build engines in the U.S. And so they only have a U.S. content of about 15% on their locally manufactured cars.
Interesting.
That's going to be, your Mercedes is about to get a lot more expensive.
Wow. Daniel, appreciate your time. A lot to think about, and I know you're going to be busy through next week as well. Daniel Roeska of Bernstein. Tesla wins and Detroit bleeds. Not a great headline.
You asked the key question, though. Can we game out the retaliation? And who is the most likely candidate for retaliation? And you have to imagine that Tesla might be the beneficiary in the United States. But how much does that increase the target on this company's back internationally at a time where you already have seen consumer pullback?
I thought you brought up a great point, too, about South Carolina. Mercedes-Benz is there.
Huge success story. Phenomenal.
BMW is there. Volvo is there. You have to imagine Governor McMaster is calling the Oval Office and saying, we have European companies headquartered here that are hiring Americans in South Carolina. Please be lenient, be flexible, is what the president has said he might do.
I think they'd like to see the parts story shift as well, which is where a lot of the employment is for that particular industry. Equities right now in the S&P negative by 0.2%. Up next on the programme, we'll get you some inflation data just around the corner and some reaction. We'll speak to the former St. Louis Fed President, Jim Bullard, in just a moment. Equities at the moment just a little bit softer. The opening bow 60 minutes away. Some economic data seconds away. We're down by 0.2% on the S&P, and the Nasdaq 100 down by a third. In the bond market, yields a little bit lower, down by 3 basis points at the moment. The 10-year 4.33. The 30-year down 4 basis points to about 4.68. Let's cross over to Mike McKee to get you another read on U.S. inflation. And Mike McKee joins us now. Good morning, Mike.
Good morning, John. We're just waiting for the numbers to drop here. Of course, we have a pretty good idea of what PCE inflation is going to be. It's coming, the numbers are dropping slowly, but here they come. The PCE on a month-over-month basis, the headline up 3%, 0.3%, which means a 2.5% year-over-year number, and that was totally as expected. That's unchanged from last month. We get a stronger core, though, up 0.4. The forecast was for up 0.3. That pushes us up 2 2 ticks to 2.8% for year over year on the core, up from 2.6%. So that is not particularly good news for anybody looking for rate cuts. Now, the number that everybody wanted to see was personal spending, and it is a relatively strong number, but not as strong as forecast, up 0.4% after a 0.2 decline last month. The forecast was for a 0.5% rise. Income comes up by 0.8% after a 0.9 the month of January. So incomes are still coming in relatively strong, gives people the ability to spend. The question is, do they want to spend, given the way consumer confidence has come down? I'll take a look at where the breakdowns are in terms of spending and wages, and you can tell us what the market's thinking of all this.
Yeah, Mike, thank you. All incremental stuff, fairly marginal, but you do see a slight move in the equity market. We're down by about 0.25% now on the S&P 500, just an additional 0.1% there. On the Nasdaq 100 now negative by 0.4. Bond yields were lower by 3 to 4 basis points across the curve at the long end on a 10-year and 30-year. Just about holding on to those levels at the moment at 4.33 on 10s, on 30s at 4.68. And just to cross over to the FX market briefly, euro-dollar essentially where it was, session lows. Euro-dollar at the moment 107.75. The data points all incremental, marginal moves, but important moves, I think, Lisa, to get your hands around where this economy is going into big policy changes through the next few weeks.
Marginally, I don't want to say the S word, because stagflation it is not when you're talking about personal income rising by 0.8%. But if you look at real personal spending coming in at simply 0.1% versus the expectation of 0.3% at the same time, the core PCE is coming in stronger, inflation up, and some of the spending that's been powering the economy just a touch lower.
Might be key, just to build on that, might speak to consumer confidence that has really sagged recently, and we'll get another read on that a little bit later this morning.
Yeah, we do get the University of Michigan final numbers. We'll see if they change a lot. They don't usually, but in this unusual time, we might see maybe a rise in the inflation numbers in particular. I can point out wages and salaries were up 0.5%. That's stronger than in January, so that is good news. But it looks like the biggest increase on the month was transfer receipts, government aid to people, up 2.2%. So the strength in overall compensation is a little bit boosted by the government.
Michael, thank you. Mike McKee there breaking down that economic data. To build on this conversation, I'm pleased to say that joining us now is the former St. Louis Fed President, Jim Bullard. Jim, welcome back to the programme, sir. It's been a while. We haven't spoken to you, I believe, since Chairman Powell spoke in the news conference, so we've got to ask you. We need your reaction. The T word making a comeback at the Federal Reserve. What did you make of that?
It's not making a comeback with me. I'm not using that word. I think that I do think that the committee has, good reason to stick with the policy rate where it is. Inflation expectations for the next 2 years in the TIPS market have been rising. They're about 3.25 today. That's a CPI-based measure, but if you put that over to a PCE-based measure, it'd be around 3% PC inflation over the next 2 years. That's what the market is thinking. That's too high for the committee. The committee's trying to get, especially core PC inflation, which came in a little bit hot here. You're trying to get core PC inflation down to 2%. So they're going to have to be higher for longer. And if it goes too much farther, they're going to have to raise the policy rate.
Wait, hold on a second, because, Jim, this is exactly what people thought that Fed Chair Powell did last week when he said transitory, the word that you will not go so far as to say, is that he would be willing on some level to look past tariff-related boosts to inflation in the short term, especially if growth was sagging, and that the Fed would have to or be open to responding to slowing growth. Are you saying that inflation, should it be above expectations because of tariffs or whatever else, it's going to be important to address?
The committee should be hitting their inflation target 2 years from now. And what the market is saying is, no, you're not going to hit it. You're going to hit 3%. That was my story here. So that doesn't sound very good to the committee. Now, maybe the market's wrong. They often have, and I'm talking about 2-year tips here, and they can move around, yes. But it's a good reason for the committee to stay where it is. I have argued that the committee's in good shape here. They didn't go as far as was previously expected on cutting the policy rate. So they stayed a little bit higher. I think that's turning out to be wise. The tariffs, when I say tariffs don't cause inflation, what I mean is that inflation's a product of monetary policy over the medium term, and it's not up to the trade representative to control inflation. It's up to the policymakers to control inflation, and they have to adjust policy appropriately given everything else that's going on in the economy. And so, and over a 2-year horizon, that's something you should be able to influence. But right now, markets are saying the committee doesn't look tight enough to get down to 2% at the end of 2 years.
Jim, do you think that the Fed should open the possibility of hiking rates again?
Well, it's not my base case, but I think the probability on that is rising slightly here. And this wasn't that radical of a data release here, but I do think that possibility is rising. We really haven't made any progress on getting core PCE inflation down, let's say over the last year. You know, I think the man on the street would look at those numbers and say, no, it's basically been flat for the last year.
Jim, one thing we've heard repeatedly from some economists, this labour market's just not as tight as it was. And because it's not, that dampens down the potential for second-round effects from the inflationary kick-up that you get from tariffs. What would you say back to that? How fertile do you think this environment is for second-round effects?
I don't know. Come on. Unemployment insurance claims, you know, ridiculously low. That's kind of your best week-to-week indicator. Unemployment rates, if anything, is probably below the natural rate for the U.S. economy, but certainly low by historical standards. I just don't see it right now. Now, there's fear of the future and what might happen, and we know that the last tariff war in 2018, 2019 did cause a slowdown in the economy, and that the Fed did react to that by lowering the policy rate. So we'll see if that history repeats itself here. So that it's the expectation that people might be thinking about. But as far as where the labor market is right now and whether that's disinflationary pressure coming from there, I don't think so.
Jim, can we have a best guess from you? Next move, cut or hike? What would your best guess be right now?
I still think the committee can stick to its baseline that there will be further cuts, but they're being pushed farther and farther out into the future. And now with a hotter core PCE year-over-year number, you might start pushing those out into 2026 instead of 2025. We'll see what the market does in the days ahead.
Hey, Jim, before you go, Boilermakers play tonight, don't they? Sweet 16?
Yes, and
you feeling good about that?
A victory for the Boilers here. We're playing in Indianapolis. I think they don't lose at home very often, so I think they've got a good shot.
Boiler up. I do that because you know the manager who does my reviews, Purdue. Appreciate it. Thank you, sir. Former St. Louis Fed President Jim Bullard. Jim,
sure.
Thank you.
It's why I picked Purdue as well.
Right?
I just say,
yes,
anyone who wonders, you know, exactly what this recipe is. John coming out saying you need to ask for raises.
Yes,
you
of
still
course.
have the leverage.
And make sure you support the team that your manager went to school
What's going
at.
on? Put it together. I don't know what's going on.
Pretty obvious stuff there, Bramo. Michael McKee joins us now, Bloomberg economics and policy correspondent. He's back with us. Mike, you've got more detail. What do you got?
Well, we like narrative economics, as Bob Schiller likes to say. We like a story about what's happening, and you can construct a story in today's data about people pulling forward their spending. Goods spending rose by 0.9%, while services fell during the month, and the good purchases were largely in durable goods, up 1.4%. So it is possible that people looked at the idea of tariffs coming and went out and bought things like refrigerators and cars that might be more expensive going forward. You can also look at the wages and salaries paid, and while wages overall were up 0.5%, manufacturing wages were up 1%, suggesting that perhaps more hours were worked there and people were putting in more time building those durable goods. So if you want to construct a story about maybe this something that would rhyme with consumer sentiment numbers, this could be it.
I think that would resonate with people, Mike. Appreciate it. Michael McKee breaking down the spending numbers, some front-loading, Lisa. Not surprising.
Yeah, which, again, dampens the other spending, which explains Lululemon pants. I mean, this basically is confirmation in the numbers of what we're hearing from a number of different, particularly retail companies or consumer discretionaries. I also want to point out that the revisions were more negative in the prior month with respect to spending. Watch this space, because this might be the fastest-moving indicator to confirm some of the rhetoric we're hearing.
Watch this market too. We're down by 0.4% on the S&P, down by about 0.5% on the Nasdaq 100. Joining us now to discuss is Mike Contopoulos of Richard Bernstein Advisors. Mike, welcome to the programme, sir. It's been a while. Let's talk about what Jim Bullard just said just moments ago. How constrained do you think this Federal Reserve is if this economy starts to weaken?
Well, you know, I think they're a bit constrained. I mean, the number one thing that they need to pay attention to is inflation at the moment, which thereby constrains them. I think Jim hit the nail on the head. You've got a really resilient labor market. As a small business owner myself, I don't know if you know, but I own a coffee shop, two of them actually, and labor is incredibly tough. It is very, very tight. And, you know, if you're trying to fight the difference between now and 2018, which Jim brought up, is that you didn't have inflationary pressures in 2018. And so the Fed's going to be, you know, quite constrained if growth falls on the margins. I mean, obviously, if there's a recession, that changes things a bit. But if you just have a slowdown in growth, I think they're incredibly constrained in what they can do with respect to the policy rate.
Do you write people's names on the sides of the cups when you hand it out to people?
We just call them out.
Well, I'm just curious. Actually, using your experience as a small business owner and a longtime credit analyst, I wonder how much you think consumers are able to absorb some of these costs. We're hearing conflicting things. Some people saying not so much. Others saying, yes, indeed, they will, and growth won't slow that much. And that's the reason why the likes of Jim Bullard just said that maybe on the margins, the chance of the Fed having to hike rates is going up.
Yeah, I think that's right. We've actually been talking about that for quite some time. I mean, dating all the way back to September prior to the first cut, you know, when a lot of our peers were saying you should be increasing duration, for example, because rates tend to fall when the Fed cuts rates, we said just the opposite. We actually said the Fed cutting at a time of strong earnings and economic growth should actually warrant selling duration, being underweight duration. And I think that's sort of where we are today as well. You know, if anything, I think, you know, the risk, I'm not saying this is the baseline, but the risk is certainly a hold through all of 2025. And yeah, I mean, I think the probability of a hike at least has to be considered at this particular point in time. Not saying they'll do that. But for our perspective as like macro investors, you know, what you really care about is what does this mean versus expectations? How does that affect, you know, bonds, credit, equities, et cetera, going forward? And the fact of the matter is, if it's still because of a strong economy, right, if that consumer continues to spend, and you are seeing that, I mean, yes, we missed by 1/10 today, but you still have a pretty strong consumer. You know, I mean, I don't know if that's terribly a bad thing either for markets generally.
You talk about the potential for 10-year yields to rise to the 4.75 to 5% range this year. What kind of probability would you assign that type of scenario?
Well, I think it's quite high, certainly north of, you know, 50%. You know, I think that you had a growth scare, obviously, in the first quarter of this year related to tariffs and uncertainty, and that caused, right, yields to fall a bit. But notice yields haven't gotten back down to that 3.6 level, which is where you were in September. The hard data hasn't been nearly as bad as what it was in July and August of 2024. The hard data actually looks pretty good. Earnings data is strong. So I almost see no reason why you won't get back up north of 4.5. Certainly, that's not a big statement maybe from where we are today. But yeah, I mean, I think 4.75 to 5% definitely has greater than 50% odds. Now, how much higher you go from there, I think things start to get hard, right? You really need to be at the beginning of another, you know, economic cycle to the upside, I think, to go much north of 5. So that 4.75 to 5 would probably be a good entry place for duration in our view.
Mike, just to finish where we started on the Federal Reserve, I think this is a really important conversation about their ability to reduce interest rates in the face of economic threats. So you mentioned last year, the end of last year, through the summer, you could feel that anxiety build around the labour market. It was clear, it was in the hard data, unemployment was starting to pick up, and they went on to reduce interest rates by 100 basis points. There are some people who believe they'll still be able to do that right now. How different do you think this moment is, the one we're in at the moment, compared to where we were late summer in 24?
So I think certainly the hard data is better today, and that's a positive with regard to the economy, a negative if you are wishing for the Fed to ease liquidity and cut interest rates. What's different today more than anything else, though, is just the amount of uncertainty out there. And I do think that there's a scarcity of certainty. And so, investors really need to be thinking about that as being just as big of a change as the hard data. And it's why we're a bit cautious and getting a little bit more cautious despite our feelings of reasonably strong growth and profits and all the sort of good stuff that comes along with that. We still think that level of uncertainty is going to be a defining feature of the next several months or several quarters. And that does warrant a bit of defensiveness and quality in the portfolios.
Mike, just before we go, we're big supporters of small business. Next time we're in Larchmont, what is it? Sunshine Coffee Roasters, is that right?
You hit the nail on the head, and we also have we celebrate our 1-year anniversary in Rye, New York as well.
Congratulations. Beautiful parts of New York. Thank you, sir. Thank you so much. Mike Contopoulos there of Richard Bernstein Advisors. You've been to Larchmont, beautiful part of the world.
It's absolutely beautiful, and evidently it's a cappuccino. I actually was looking
just
it
on
up.
The water. You've been looking at the menu.
Yeah, I was looking
Nice.
at that. You can call my name out.
I've been looking
Cappuccino.
at prices. In February, the average price of ground roast coffee actually hit a record. So I imagine he's dealing with some
He's passing that on. Yeah, this is important stuff. Thanks for that, Annmarie. All right, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with a recap on that economic data. The Fed's preferred measure of inflation rose in February. Core PCE increased 0.4% from January, slightly higher than estimates, calling for 0.3%. At the same time, household demand came in weaker than expected, signaling a more cautious consumer. And staying on that, Lululemon shares are plunging more than 11% in the pre-market after the company delivered a disappointing outlook for the year. The CEO saying U.S. shoppers are keeping their wallets tight and visiting stores less often due to what they say is geopolitical strife and high inflation. The retailer joins a growing list of companies raising consumer concerns. And CoreWeave raised $1.5 billion in its initial public offering, selling 37.5 million shares at $40 apiece. All those metrics fell short of expectations, which were to sell 49 million shares at $47 to $55 each, which could have raised as much as $2.7 billion. So a miss there. CoreWeave shares will begin trading today on the NASDAQ under the ticker CRWV. That's your Bloomberg brief. John?
Hey, Yahara, thank you. I know Matt Miller and the team will pick up on that story in about 15 minutes' time, so look out for that. Up next on the programme, we'll set you up for the day ahead. We'll head down to the nation's capital and catch up with Tyler in Washington, D.C. From New York, this is Bloomberg. The opening bound's about 39 minutes away, so here's the price action for you. Just a little bit softer. We're down by 0.4% on the S&P. The Nasdaq 100's down by 0.5%, and the data, Lisa, of the last 20 minutes or so, not exactly supportive of the bull thesis.
You have essentially an increase in the expected core PCE, so that came in hotter than expected, just slightly on the margins, and slightly weaker spending on the margins, but just confirming that trend.
Encouraging the bears out there. We're negative by 0.25% on a Russell. As we count you down to the opening bell, your trading diary, the next week or so looks like this. Later on today, you will get UMich consumer sentiment. We will also get JOLTS and ISM manufacturing. Look ahead to next week. On Wednesday, President Trump's Liberation Day, plus ADP and durable goods. On Thursday, another round of jobless claims and ISM services data. And on Friday, next Friday, this time next week, payrolls, the major data point. Joining us now, Tyler Kendall from Washington, D.C., from the nation's capital. Tyler, can we confirm that call is taking place between those two leaders this morning?
Well, John, there are reports that it is currently going to happen later this morning. We have to keep in mind that this would be the first call between the two leaders since Carney was sworn in as prime minister amid what has been escalating rhetoric between the two of them. Carney, of course, largely campaigning on countering President Trump. He told reporters yesterday that it was the White House who reached out to him to schedule this call. Now, we normally get confirmation and a readout about what happened on a post on Truth Social, so we'll be paying close attention to that. I just want to quickly add one more thing to your radar today in Washington. U.S. mayors meeting with Canadian mayors about tariffs. I bring that up, John, because just yesterday a new report from Canada's Chamber of Commerce says that U.S. cities that are expected to be hit the most by Canadian export tariffs are in states that President Trump won, like Detroit, Michigan, and San Antonio, Texas. Both of those mayors will be here in Washington today.
Tyler, thank you. Looking forward to your coverage through today. Bloomberg's Tyler Kendall, just outside of the White House in the nation's capital in Washington, D.C. Can we negotiate some of these issues away?
This is the tricky part. Can you put the genie back in the bottle at a time where there is public opinion that's moving very quickly? And for whom can you put this genie back in the bottle? I go back to what Torsten Slok pointed out yesterday, that future flights between Canada and the U.S. have fallen 70% since all of this has gone on. So you have to imagine people vote with their feet, and it's hard to really reverse all of this in short order.
They're going to try. The United Kingdom's going to try. We know India is currently trying. Interesting, CCTV is coming out right now, giving a bit of a readout on Jamieson Greer, USTR ambassador, the trade representative of the United States, who had a call earlier this week with the Chinese vice premier. And China apparently told Jamieson Greer it will retaliate versus the reciprocal tariffs that are expected to come out next week. So this is just going to be the start, as many people have been telling us, of a tit-for-tat trade war.
I realise I do this every single Monday morning, look down the barrel of the camera and say, huge week coming up. Next week, the amount of economic data that we get on the job side for the labour market, ADP, JOLTS, jobless claims, payrolls, and then this really pivotal week potentially for trade as well. We've been anticipating this April 2nd day now for weeks.
I remember when you used to say huge week ahead, and I'd think, oh, that's going to be fun. That's going to be exciting. And now it's like another one. I mean, there's so many different things, and every week is turning into a month. Next week, though, could be pivotal. Do we get certainty around the trade story? And if we don't, that feature of uncertainty starts to get priced in a different kind of way.
Or does that uncertainty just persist? Next week, I'm going to do it right now. Huge week coming up next week. Payrolls this time next week. Lots of economic data. And April 2nd is Liberation Day in America. How will this market react to that? What a lineup we've got for you to kick off Monday morning. Laurie Calvasina of RBC, Mike Wilson of Morgan Stanley, Daryl Cronk of Wells Fargo, Neil Dutter of Renmac. From New York City, get some rest this weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Novak Djokovic is into the Final Four after he took out American Sebastian Korda in straight sets. The 24-time major champion fought back from a set down in the second set, closing it out in the breaker after just over an hour on court. And don't forget, you can watch all the action live daily on Tennis Channel.